Everyone, a minute to go until the start of cash equity trading. I'm Francine Lacqua here in London, and here are your top stories. Ukraine says a nuclear plant in the east came under attack and is now occupied by Russian forces. An earlier fire is now said to be contained. Stocks sink. Havens are bid on the news, while Russia's stock market will remain closed in the country's longest ever shutdown. Plus, commodities are on course for their biggest weekly surge in at least 60 years. Oil heads for its biggest advance since 2020. So let's look at futures. Now, it has been quite a week, so we have to put everything into context with a lot of the slide that we've seen, especially commodities really on a rise. We've never seen anything like it. In the last week, they've gained the most since 1974, commodities as a whole. Now, today, futures pointing to a lower start. Of course, many questions are about, first of all, how far Vladimir Putin would go, how the sanctions are impacting some of the corporate and debt sales. And I guess after the week that we've had, of course, looking at the military strikes, looking at the human loss of life, a lot of traders are taking stock and deciding what to do next. Right, as these markets opening up again, once again, it's this column I really want to focus on. It's commodities, the gas oil pretty much unchanged, iron ore pretty much unchanged for the moment, because we've had those pretty brutal moves in the last couple of days. And of course, with this renewed attack on the plant in Ukraine, the fact that there was firing overnight and now the Russians have taken over, it sent really quite a lot of jitters on the markets, also thinking about the worst, which does not seem to be a possibility right now. The France CAC 40 opening -1%, and then the FTSE down 0.3%. Let's also look at some of the other commodities, the softer commodities. So you can definitely also see a bid for havens if you look at, for example, the Swiss franc 0.9188. But it's a lot of the softer commodities that have also had this huge price swing. So we don't only look at corn, but we also look at some of the wheat futures. And of course, we'll be up to date with all of the security surrounding possible other nuclear plants in Ukraine throughout the day. We are expecting a press conference from the IAEA a little bit later on. Wheat, you can see currently getting some 6.6%. The fun fact, or not fun, but the fact of the day is actually Egypt, one of the biggest consumers of wheat after China from that region. The US 10-year yield, you can see at 1.8043. So that's a market check. Let's also get over to some of the other things that we're watching to delve deeper into these markets. Our Bloomberg MLive managing editor, Mark Cudmore, joins us. Mark, you're looking at liquidity in equity markets. How lousy is it?
It is lousy, Francine. It's pretty terrible. We have seen some pretty extraordinary moves over the last couple of months across assets. And in fact, this morning, probably the most dramatic moves might have come in treasury markets. At one point, 5-year US yields fell 15 basis points in only a few minutes when we got that headline saying nuclear, Russia, Ukraine. But obviously, we have paired those moves and we're back to only a couple of basis points in the day. This time, though, I want to focus on S&P 500 liquidity. Now, this is an index that is built by our colleague Cameron Christ in New York as a way of estimating S&P 500 liquidity. What it is kind of comparing trading volumes relative to the day's trading range. So obviously, when there's a lot of liquidity, you'd expect to be able to execute a large amount of volume without moving the market that much. When there's poor liquidity, just a small amount of volume sees a very large trading range. And looking at this way to look at the market and look at liquidity, you can see that we are seeing the third worst liquidity in the last 17 years. And in fact, the only two times we've seen worse in that period were right in the depths of the great financial crisis. Post-Lehman, as you know, we were worried about the whole financial system collapsing. That was terrible. And again, in the first wave of the pandemic panic in March 2020. Apart from that, we are in the third worst liquidity regime, which means even without a jittery news flow, we would be seeing some volatile moves, some gappy moves back and forth. But now we've got the news flow to justify it as well. Expect volatility to stay very elevated in both directions.
Yeah, and I guess, let that sink in for a while and, of course, consider repercussions if it gets even worse. So thank you so much, as always, our Bloomberg MLive managing editor, Mark Cudmore. Now, Europe's largest nuclear power plant in Eastern Europe has come under attack from Russian shelling. This is according to Ukrainian officials. It raises the stakes in Vladimir Putin's invasion as his forces bombard cities across the country. Ukrainian authorities say the plant is now occupied by Russian forces. Now, let's get straight to our reporters on the ground. Bloomberg's Aggie Cantrell at the Medica border crossing in southeast Poland with the latest, and our Bloomberg executive editor Will Kennedy tracking the massive moves we've seen in commodities. Also with us, Christina Kino, as ever, our markets editor, looking at the global market fallout. So thank you all for joining us. Aggie, it seems the fires have been extinguished. What does this mean for the progression of the conflict?
Hi, Francine. Yes, so the fire that broke out at this nuclear plant was in 3 floors of a training facility. It has been made clear that it didn't have any, that the nuclear power facilities themselves were not actually at risk. But it is also showing, and it was clear when President Volodymyr Zelensky spoke earlier today, that he's pointing that this should be a wake-up call to Europe, that the risk that this poses and the Russian continued war with Ukraine is clearly going to continue to cause risks like this going forward. And so he wants to call on European leaders to pay attention to what is going on and to react accordingly.
So, Aggie, what are leaders doing? We've also heard from the U.S. Secretary General, of course, in the U.S. Apart from having task force trying to be ready at hand, is there anything else that they can do?
Zelensky spoke this morning to Biden and also to Chancellor Scholz in Germany and Johnson in the UK. And it's clear that what the Ukrainians are pushing for is to make sure that there is more support for their troops on the ground. But it is also important to note that this is not just a concern for Ukraine. Obviously, any concerns over the stability of nuclear reactors in Ukraine is obviously a concern for Europe as a whole. And so that's going to be something that European leaders are looking at more closely this morning.
Aggie, thank you so much. Well, we've seen, of course, a wild week in the commodity markets. If if somebody wakes up and there's just the word nuclear compared like energy, Russia and Ukraine, people freak out. How's it playing out across the energy space?
Well, when these reports initially came across the wire early in the Asian morning, in the middle of our night here in Europe, commodities spiked because it was clear escalation of the war. The risk of a nuclear accident would be incredibly alarming, but since then markets have calmed down as it's become clear, as Aggie explained, that the fire only affected a little bit of the plant.
So, well, we've also been, of course, we're also seeing climbing higher in agricultural commodities. Wheat, again, gaining some 7%. What impact is that having?
Yes, I mean, this has been one of the biggest impacts. A lot of focus on energy, of course, but Ukraine and Russia are agricultural powerhouses. Between them, they account for 25% of the world's wheat exports. Ukraine is a big grower of corn, a vital feed for the world's animals, and a very big supplier of edible oils through its sunflower crop. So the market impact there has been dramatic. And now we're getting towards the time when Ukrainian farmers should be planting their next harvest, for their next harvest in the autumn. It's unclear if that's going to happen. This is going to continue to reverberate through agricultural markets. And we've seen wheat at the highest since the global financial crisis, corn set multi-year highs. I mean, this is going to come through the food supply chain very fast.
Well, thank you so much. And Christine, of course, everyone's on knife edge, thinking about the worst when some of these headlines cross. What does it mean for markets?
Well, Francine, I think there is definitely a lot of anxiety and caution in markets this morning. We're definitely once again seeing that haven bid. Treasuries are a favored asset this morning, as is the U.S. dollar, and that's really creating ripples across financial markets. And of course, very specific to Russia, we're still very much watching on the ground, trying to get a sense from investors and traders. How are they doing with their Russian asset holdings? Have they succeeded in offloading this? Because we know that there's been a massive effort to really do that over the last few days.
Yeah, and of course, Russian corporate debt getting a lot of attention with, Gazprom, I think Rosneft coming up Sunday and Monday, I think, in terms of payment of coupon. Like, what do we know? How do we know what will happen?
Well, Francine, definitely keeping an eye on those coupon payments that are due, because there is a lot coming over the next couple of months, both from the corporate sector as well as the sovereign sector. We're still really trying to get a sense from investors on the ground, what sort of anxieties or preparations are they making in terms of trying to figure out how to get these coupon payments. There's still a lot of confusion in the ground over whether that money can actually leave the Russian borders. We know that there is still this ban in place for that money transfer overseas to foreign bondholders, and so that will have big implications for some of these bondholders overseas, and whether they are going to get these payments and whether the ratings agencies will consider that a technical default.
Yeah, and of course it depends on some of the money where these companies have it, whether they can pay to institutional investors or not. What does that mean for liquidity?
Well, Francine, liquidity, as we know, is not doing well at the moment. Mark just showed us the chart earlier on equities. Liquidity is the third worst liquidity event over the past couple of decades. And I think we're seeing very much a similar picture in the bond market. Again, gauges across the globe, both in the US, UK, and European markets, some of these measures are hitting levels that we didn't see since the pandemic started in March 2020. And there's also a very direct implication for liquidity here based on what the Russian central bank potentially holds in its FX reserves, because those are massive in their balance sheet, as well as some of the sanctioned entities. Yesterday, for instance, we heard from the German finance agency that they are raising the liquidity of some of their bonds, which are being held by sanctioned entities.
I mean, and you can see it on the screen. Funding stresses are surging to 2020 levels. Christine, without stemming any panic, we also can't rule a default, right? Either on a sovereign or on a corporate.
Absolutely, Francine. I think this is still really the question that's hanging over investors at the moment, because again, trying to parse the mechanics of how exactly these payments are going to be made on Russia's obligations is still very much unclear at the moment. Even if technically these payments are being made to depositaries within the country, that those funds can't necessarily leave the country and get to the bondholders. And so again, it really is a question of how would rating agencies, how would investors define what constitutes a default at this moment? There's of course a 30-day grace period that usually applies to these sorts of obligations. And so it would be a question of watching whether that applies in this situation and what happens when we get past that 30-day period.
Christine, thank you so much. Christine Aquino there, our markets editor. Of course, the other story to this is we've had some breaking news with Goldman Sachs and JP Morgan having purchased and beaten down company bonds in Russia, something that they haven't commented on, but of course it's getting one of our most top-read stories on the Bloomberg terminal. Christine Aquino, Aggie, and of course at Poland's border, and our executive editor, Will Kennedy. Thank you all for joining us. Now, coming up, we'll speak to Caroline Simmons from UBS Global Wealth Management about the market impact of the war in Ukraine. This is Bloomberg.
Is moving 8,500 more troops to Eastern Europe. If they're not being deployed to Ukraine specifically, why is that so important, and does that risk further provoking Russia?
Well, there's two things going on. So what the United States recently announced is that we are going to put 8,500 troops that are part of the NATO response force on high alert. That means they'll be ready to deploy on a moment's notice should we need those forces anywhere in Europe to protect NATO territory. In addition, the United States is also looking at possible additional moves that they might make to move U.S. force posture into Central and Eastern Europe. The reason we're looking at that is because a lot of the members in that neighborhood in Central and Eastern Europe feel concerned. And so we are looking at what measures we might take in the name of reassurance and deterrence.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to the Open, everyone. 14 minutes into the European trading day, and you can see European stocks down 0.5%. So I think we're actually accelerating some of the losses that we saw earlier on. The DAX, the CAC, and the FTSE get down by 1.2%. Now, Russia's military action and sanctions imposed by the U.S., of course, on its allies are creating a range of risks, be it, of course, energy prices, be it what we're seeing in some of the soft commodities, and then the rules of engagement in this military conflict are quite still up in the air. So we'll see what happens next. On that front, we look at corporate bonds in Russia. We also look at futures in the U.S. This was interesting yesterday because as soon as futures started to do a bit of a reversal, then also European stocks felt a little bit better about what could be happening in terms of freezing out. Russia, the 11th biggest country in the world, the S&P 500 futures, NASDAQ futures, Dow Jones futures, I have to say pretty much unchanged as we speak. Now, Ukraine says Russian forces have occupied the site of Europe's largest nuclear power plant. In a video message earlier today, President Volodymyr Zelensky says Europe must wake up, adding that he also spoke with the UK Prime Minister Boris Johnson, the German Chancellor Olaf Scholz, and other world leaders. Now, for more, we go to our European correspondent, Maria Tadeo. So, Maria, NATO leaders have reacted. What are they saying?
Well, Francine, we've heard it from President Biden, the U.S. administration, the Canadian Prime Minister Justin Trudeau. We've heard it from the U.K. Prime Minister, too, say that they are incredibly worried about the nature of attacks that we see around key strategic points, including a nuclear plant. They say that this is incredibly dangerous and it is reckless, and Russia should stop doing this. Now, the other thing is, of course, after this fire broke out near this plant in Ukraine, I did text one of my sources in the EU in Brussels asking, what is your reaction? And what they say is that for the time being, they just want to get real-time data and confirmation that this fire is now under control. But they also want to know who is on site, who is controlling this plant. Another thing, Francine, that I've been told is that over the past 48 hours, there is concern that Russia has escalated both on the military aggression from the air to the ground, but also on the language that it's employing. We've heard that Vladimir Putin says, I am going to put my nuclear deterrence on a high alert. Yesterday, we had similar comments from the Russian Foreign Minister, Sergei Lavrov, and we know that in a call between Vladimir Putin and Emmanuel Macron, he left that call believing that Vladimir Putin will continue this war and potentially the worst is yet to come. So they really do worry about what we see in terms of the actions, but also the language that at this point does not point in any way to de-escalation.
Maria, thanks so much. Maria Tadeo there, our European correspondent for us in Brussels. Now we're back with Caroline Simmons, UK Chief Investment Officer at UBS Global Wealth Management. Caroline, great to speak to you today. So thank you so much for coming on Bloomberg. I mean, there are a number of risks in terms of what the markets are looking at, possible defaults from Russian corporates, of course, inflation. What do you see as number one risk?
Yeah, I think it's the interplay between inflation and whether the commodities will stay elevated enough for long enough that it demands destructs, and therefore you get downgrades to GDP growth. I think that's really the key driver for the markets over, a sort of few weeks or months period.
So what does it mean for your investment strategy, Caroline? Where is anything safe at the moment?
So, when we're doing our investment, we obviously have our scenarios. We're positioned for our base case scenario, which is that we kind of stay in the situation that we're in, which is a very strong growth backdrop, but with continued conflict and therefore continued upward pressure on commodities. So we have a preference for equities. And within that, the things that we thought were doing well anyway in our base case, which do even better under the conflict, including energy, commodities, and cybersecurity, are areas that we like. Also, some healthcare, which is obviously a bit more of a defensive play, helps us on the days when the markets are more concerned about the risks. And it obviously also has some long-term drivers and is a dollar play as well. So that's quite helpful given the dollar's been strengthening.
Caroline, if you look at some of the liquidity out there, and this is, it's been lousy liquidity, how much worse could it get? And what does that mean for the global stock market?
Yeah, I mean, liquidity is interesting. It tends to exacerbate moves when the liquidity is low. So it gives a feeling of higher volatility, which is kind of counterintuitive, because when you see the market sort of swinging around, you think, oh, must be everyone's trading, but actually it could just be fewer people are trading, and that's why it's swinging more. I think a lot of people are uncertain at this point. Obviously, no one knows how this situation is going to develop, and therefore, probably people aren't taking big bets or changing big positions. They might be adding some hedges or, trimming things around the side, but we have this very sort of dichotomous situation where we have extremely strong growth and earnings, but obviously high risks on the other side, and this very sort of growing threat from inflation rising due to the commodities.
But does it just automatically mean that we're going to see a lot more volatility?
Yeah, I think so. I mean, at the start of the year, we said there'd be volatility this year anyway because of coming out of the pandemic and monetary policy normalization. And now, obviously, on top of that, we've got a war, which clearly is adding volatility to markets. And, I think that that is something that, we have to learn to live with. But what's interesting is we've also seen the intraday volatility been increasing as well. We have seen some phenomenal swings throughout the course of the day. And, again, I think this is a representation of A, low liquidity, but B, we are getting some people take short positions, then, the market falls, they close the position, you get a short squeeze. So, we need to kind of just try not to get too caught up in these short-term things and sort of sit back and think, what's growth, what's inflation, where are valuations, and what are the different scenarios that could transpire that could change the assumptions around those in order to form an investment view.
Caroline, the Russian stock market actually closed for trading until next Wednesday. We haven't ever seen anything like it. It's, it makes a record in the country's modern history, and they're really trying to protect some of the domestic investors. What are the chances of a default, either a Russian sovereign or a corporate that also impacts, UK investors?
Yeah, so, the direct exposure of a lot of the European markets to Russia is relatively limited. There may be some companies that have particularly high exposure, but at an index level, we're talking a couple of percent. So I would say it doesn't have a big impact from that perspective. Obviously, if you get a sovereign default, that is a big event, but clearly the size of Russia relative to global markets and also from a GDP's perspective is very small. It's 2 to 3% of global GDP. And so, it's not that a default would necessarily cause widespread disruption to financial markets. It would obviously be very, very disruptive for individuals and corporates, directly affected by that.
Caroline, thank you so much. Caroline Simmons, UK Chief Investment Officer at UBS Global Wealth Management. Now, coming up a little bit later this hour, we'll get more, of course, on the markets and situation in Ukraine with David Serra from Algebris. We'll look at the second and third round effects, of course, on the banks as well. This is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
Welcome back to the Open, everyone. 24 minutes into the European trading day, and their stocks are actually falling along with European U.S. equity futures. A bit more of a reversal, but it's a very clear bid for some of the havens, including sovereign bonds, that have been rising after Ukrainian officials said Russian troops shelled a major nuclear power plant. Now, let's also get an update on some stocks on the move this morning with Bloomberg's Danny Berger. Hey, Danny, what do you have?
Well, Fran, I was really prepared to pick out some individual stocks that maybe were moving on earnings or other corporate stories, but yet again, we're faced with another day where everything seems to be moving off the macro picture, off concerns as this war develops. Daimler Truck is one of these, so they were announced yesterday that they'd be added to the large cap DAX index. Now, usually this is a really positive thing for a stock because getting added to a bigger index means that more passive flows are going to come into it. But this is a really great encapsulation how markets just don't care about those kinds of stories today. Daimler Truck down nearly 3%. Autos are the worst sector today. They've been performing very poorly all week just because of the supply chain issues that are added to an already difficult situation now that we have a war in Ukraine. One of the few sectors that's on the move higher today is utilities. Again, a very macro picture. It's this bid for safety, the perceived safety of things like utilities and real estate, some of the few sectors to be up today. But meanwhile, we're looking at banks also hurt. Deutsche Bank down 3%, telling, according to an FT report, looking at their IT operations in Russia. Francine.
Danny, thank you so much. Danny Berger there with some of the stocks on the move. In the meantime, of course, Russia's invasion, we're on day 8. The invasion of its neighbor and really transformation into an economic pariah means that all bets are off when it comes to the economy and some of the industries that we're watching. So they've really shaken sentiment before the latest escalation. Energy, metal, grain costs have soared as traders shun Russia's oil and other resources. Also, just a reminder, the Russian stock market will be closed to trading until at least next Wednesday, marking a record in the country's modern history. Coming up, more on the war in Ukraine and Europe's worsening energy crisis. We speak to Nathalie Loiseau.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. sekarang nggak pernah lagi dapat segitu, sama aja. Belum ada turis ke Bali, masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to The Open, everyone. 30 minutes into the European trading day, and here are your top stories. Ukraine says a nuclear plant in the east came under attack and is now occupied by Russian forces. An earlier fire is now said to be contained. Stocks sink, havens are bid on the news, while Russia's stock market will remain closed in the country's longest ever shutdown. Plus, commodities are on course for their biggest weekly surge in at least 60 years. Oil heads for its biggest advance since 2020. So let's get straight to the markets and see what the picture's like over there. Of course, a lot of the focus is on the military ongoing invasion of Ukraine. You can see the DAX, the FTSE, and overall the stocks, Europe 600, almost gaining, well, down by 0.1%. But for the DAX, it's almost down some 2%. Let's also look at the sectors that are on the move. Of course, this all has to do with the markets panicking, really being on tenterhooks when they saw that first headline coming out of Russia and Ukraine about the nuclear plant. Now, it does seem to be secure at the moment, but again, we don't really know exactly what will happen in the next couple of days. We look at the fallout for energy and some of the other things that we're watching, including metals. Auto parts down 2.8%, insurance down 2%, and banks also significantly on the lower side. So this is what we're looking at in terms of on the ground. Europe's largest nuclear power plant in Eastern Europe, or Eastern Ukraine, has come under attack from Russian shelling. Kyiv says the plant is now occupied by Russian forces. This as Europe faces a major energy crisis, which is set to get worse as the war in Ukraine escalates. Now, we're now joined by the MEP, Nathalie Loiseau. She previously served as France's Minister for European Affairs under President Macron, who, as we've been reporting, had a tense 90 minutes phone call with Vladimir Putin. We're also joined by Bloomberg's Europe correspondent, Maria Tadeo, in Brussels. So thank you, Maria, for joining us. Madame Loiseau, thank you as well for joining us. Nathalie Loiseau, let me ask you this. We've had quite a lot of sanctions. There are more oligarchs that are also being sanctioned by some powers around the world. What should the end game be? How much of this impact will have on the military advancement of Russia, and how much of it is to freeze out Russia for a longer term?
Well, we do hope that the Russian president and the Russian people realize that they have everything to lose and nothing to gain in this military adventure, and that they stop the war and turn to diplomacy. This is the reason why there are very strong sanctions, and at the same time a diplomatic path where Emmanuel Macron still talks to Vladimir Putin, because we have to find a way to get a ceasefire, to get humanitarian corridors, and to have people getting back to the negotiating table.
But realistically speaking, how is that doable? Because we know that yesterday Vladimir Putin had a call with the French president, who believed the worst is yet to come. Yesterday, Vladimir Putin continued to say, I have an invasion to carry out. He still says this country has been Nazified, which of course many argue is a horrendous comparison. What can you put on the table, or what should be put on the table so that Putin de-escalates, if that's even possible at this point?
Well, as you know, sanctions were decided swiftly and in coordination with the European Union, the United Kingdom, the United States, Canada, and others. They are being implemented right now. It started a few hours ago. Some 7 Russian banks will be disconnected from SWIFT in the coming days. So I would say on the sanction level, the worst is yet to come as well. I hope that the Russian president and the Russian people realize that it's really not worth it, especially if we listen to the Russian narrative. Of course, the denazification is a purely invented alibi, as well as talking about threats from Ukraine to Russia. There were never any sort of threat coming from Ukraine.
And to your point, we haven't seen the full impact, as you say, of the sanctions because the Russian market has been shut for a week. So we really haven't seen the full impact that this had on Russian assets. But I wonder, there's a real debate in Brussels as to what can we do next? And a lot of this has to do with energy. We know that French President Emmanuel Macron has said that nuclear could be the way forward on top of green. I wonder, is it time to really ditch full imports of Russian oil and Russian gas?
Well, anyway, it's time to get rid of oil and gas as much as we can in our energy mix. We know it for other reasons. We know it because of climate change. And now people finally realize, but it takes a war for them to realize that their dependency on Russian gas has made them weaker. It's about time that there is a wake-up call. I hope that especially in Germany, this wake-up call is strong. We are already working on getting gas supplies from other suppliers than Russia to be able to say, all right, we don't really need you.
Yeah, Nathalie Loiseau, do you think that Vladimir Putin would be actually capable of using nuclear arms?
Well, I will be extremely cautious because when you talk about nuclear, every word counts. Unfortunately, he hasn't been cautious when he talks about nuclear. I think he's trying to intimidate both Ukraine and the West. He's trying to get some peace movements asking for any kind of peace whatsoever. I also think he's trying to gather the Russian people. When he yesterday, I think it was Sergei Lavrov who said that the West was threatening Russia with nuclear weapons. No one wants to use nuclear weapons. I think we have to keep calm. I think it's serious, but there is no reason to indulge into using crazy words in such a dire situation.
Thank you so much for joining us. French MEP Nathalie Loiseau, also with us at Bloomberg's Mariette today. Now, we also just heard from Anthony Blinken and Mr. Stoltenberg of NATO, reminding everyone that NATO is not part of this conflict because it is a defensive organization. Mr. Blinken's Secretary, of course, the State of the United States of America, says if the conflict comes to us, we are ready for it, talking about the United States. Coming up, Russian companies may be suffering under Western sanctions. Some Wall Street banks, including Goldman Sachs, are reportedly pouncing on their cheap corporate debt. The details next. This is Bloomberg.
The Omicron variant and the latest wave have an impact on not only consumer trends, but your business. And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
We're looking at live pictures of NATO headquarters in Brussels, where we're just hearing from the foreign minister of Germany, Annalena Baerbock. Of course, the significant escalation overnight, or certainly the significant worries overnight about a possible attack from Russia on a nuclear plant, really sent markets down, and foreign ministers are trying to deal with the fallout. Just moments ago, we heard from Secretary Blinken saying that if the conflict comes to the U.S., they are ready for it. Now, as the West tightens sanctions on Russia in an attempt to choke off investor demand for its assets, parts of Wall Street are jumping on the buying opportunity that it's creating. Bloomberg understands that Goldman Sachs and JP Morgan have been purchasing beaten down company bonds tied to Russia in recent days. Both banks have not commented on it. Now, Davide Serra, Chief Executive Officer and founder of global asset management firm Algebris, joins us with the very latest. Davide, thank you for joining us. Many questions actually on just the exposure of banks in general. We have a good chart looking at what European bank stocks have been doing overall as an industry in Europe. It's down 25% since the invasion of Ukraine. The worry is what? Exposure to certain bonds, or the fact that they have operations there?
You see, typically when you have a major catastrophe like this one, the first reaction of the investor is to look at the overall gross exposure, over gross assets, and assume all of them are losses. In reality, we've been running an analysis based on what happens if this is a 1998 scenario, so deflagration tomorrow of all the Russia, so 100% default and basically chaos, or it's more likely like a 98-99 scenario or a 2008 and 2010. The good news for investor is currently the market is pricing basically 2 to 3 times a 1998 scenario. So basically that, you have 100% losses on sovereign debt, corporate debt, and the total fallout basically of all Russia, which I think is premature for the time being. As a result, Davide, I think stocks have more than priced this.
Even some of the individual banks, I mean, how do we know about the exposure and some of the second and third round effects of freezing such a huge country? It's the 11th biggest in the world, on some European banks that have direct links, including the Italian banks.
Of course. So there are 2 types of exposure. You have the direct exposure funded in ruble. So you borrow ruble in Russia, you lend ruble in Russia. That's basically UniCredit and SocGen. They have about 1% market share in Russia. So the worst that can happen is you leave the equity and the keys. That's what happened to Santander in Venezuela. That's what happened to Santander in Argentina already, and in the tequila crisis to pretty much anyone. Second exposure is if you have cross-border exposure. So you're lending money out of Paris, London, New York to basically Russian corporates. For example, JP Morgan and Bank of America are probably the most exposed banks to Gazprom. And there it depends, because they can pay and they're not under sanction. And as a result, and if your exposure is cross-border and not domestically, you're probably going to get paid back. So it all depends what's going to happen over the next couple of months. But I would assume that currently the domestic exposure is more than priced 2 to 3 times in terms of potential expected losses. Then there are clearly the third round effect.
Yeah, go ahead on the third round. Sorry.
Third round, it's the global macro repercussion out of this. It's too early to tell, but clearly this was to lead to a massive recession. So let's assume GDP next 2 years goes -5 in Europe, then that's probably not priced in, but we don't think that's the case.
But in terms of the second round effects, I mean, do you assume that, you know, Fortress Diamond, JP Morgan, will be able to deal, even if they have a huge exposure and something ugly happens with Gazprom, that they'll be able to deal with it? But some of the more smaller European banks are much more vulnerable. And again, when do we find out? And is it the Swiss banks or is it the Italian banks?
Well, I think the Italian banks don't have, you know, as I said, UniCredit has a domestic operation. So, you know, they lent 80 ruble, they borrowed 100 ruble domestically. So they're insulated. There's no cross-border exposure. Worst come worst, they leave the keys. For Intesa, it's even minimum. It's only cross-border and it's to mainly European corporates which have business in Russia. So basically, the credit risk remains European. SocGen the same. One which is at risk is Raiffeisen in Austria. They have more exposure. The two are all region, if you include also Kazakhstan and Ukraine. And they are, in my view, for example, they suspended the dividend, so they're taking care. They're the one more exposed as percentage of equity and loans, and it's small Austrian banks.
So has it, you know, changed the way how you want to invest in European banks because of third round effects, or you're still fully committed to some of the share prices that are actually below certainly their U.S. counterparts?
No, actually, I think in my experience, having lived through particularly the 98 Russian crisis, having lived through the Korean chaebols and all the various emerging market crises, I think this is a great time to step in stocks, the ones which are very well capitalized under the ECB with massive protection, because the opportunity is pretty unique. And here, as I said, the market has priced 3-4 times the worst case 1998 scenario, which was full deflagration of Russia. So it means you apply a zero to pretty much any Russian assets, debt, or loans that you have. And if you price it 2-3 times, the worst is already in the price.
Davide, we have this story on the Bloomberg terminal through our reporting. Goldman Sachs and JP Morgan, we understand, have been purchasing some beaten down company bonds in Russia or tied to Russia in recent days. Wall Street seems to be pouncing on Russia's cheap corporate debt. We haven't been able to get comment from those companies, so that's something to bear in mind. But how big of a reputational risk is there in buying things that could give you returns but are linked to Russia right now?
Well, I think the first issue is whether it's legal or not legal. I'm sure both Goldman Sachs and JP Morgan are all acting within what is legal. So, for example, I know that in Europe, for example, you cannot buy ETF linked to Russia. You cannot put new trades. You can only sell. The good question is where you're selling to. So who's allowed to buy on the other side? That's a regulated entity. Then if it's a U.S. debt traded in the U.S. Of a major Russian corporation, it could be that if you're not sanctioned, so let's assume Gazprom, because, you know, oil and gas are not within the sanction list for the time being, you might be able to own it. At that point, when it becomes sanctioned, you cannot buy more. I don't know whether you can sell. It all depends what the regulator wants. Clearly, I think if they were doing it, we're talking about tiny amount of capital. You know, last week, Sberbank had a market cap of $140 million. So, you know, even if you buy 1%, you know, you're investing $1.5 million, which is basically, you know, a millisecond within JP Morgan and Goldman Sachs balance sheet. So it's completely irrelevant. It's a great story. It doesn't matter anything from the amount point of view.
But do you think markets now need to look at morality, even if some of these companies are not sanctioned?
I think markets need to look at the law. It's not market's job to be moral. It's market job to be legal. Because, you know, the morality is given to politicians to set up the rules, and we follow the rules. We're not elected people. The elected people are those that set the rules, and hence I think they are the only one that can decide what is moral and not moral, and they give us law, which we all respect and follow.
Davide, thank you so much, as always, for your insight. Davide Serra, their chief executive and founder of Algebris. Now, coming up, we hear from the Belarusian opposition leader, Svetlana Tikhanovskaya. That is, of course, on Ukraine and the latest developments there. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Here in London, in Sydney, in San Francisco,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
To recap the headlines.
You do not want to miss this
story. How are you thinking about those dynamics?
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the Open, everyone. 51 minutes into the European trading day. Stocks falling in Europe. U.S. futures actually trimming some of the earlier losses after Ukraine said a nuclear plant fire caused by Russian shelling of the area was extinguished. We also have some U.S. jobs data a little bit later. Now, the largest nuclear plant in Europe has been shelled and occupied by Russian troops. This is according to Ukrainian officials. It raises the stakes in Vladimir Putin's invasion as his forces bombard cities across the country. One country which has been a key ally for Putin during the war is Belarus. While President Alexander Lukashenko allowed Belarus to be used as the staging ground for drills and pave the way for the Russian assault on Ukraine. Lukashenko's government has been bankrolled by Moscow for many years, helping him staying in power after the disputed 2020 election. Well, joining us now is Svetlana Tikhanovskaya, former presidential candidate for Belarus, a key opposition figure. Also joining us is Maria Tadeo from Brussels. Thank you so much, Ms. Tikhanovskaya, for joining us. First of all, how would you describe Belarus's involvement right now? Are they bombing and occupying Ukraine?
First of all, let me correct you. Lukashenko is not the president of our country. He lost his legitimacy in 2020, and since then, people are resisting again his power. But of course, we see that he's controlling the situation, or maybe he's not controlling military situation, because we see that there are some regular troops might be sent to Ukraine in the next few hours or days. Our troops hesitate and delay. They don't want to fight against Ukrainians. And I released an appeal to them, refused to go, defect. You have the right not to follow the regime's illegal orders. When you cross the border, change sides and join the Ukrainian troops. Many Belarusian officers and soldiers already join Belarusian independent units and fight alongside with Ukrainians.
And of course, you have also said that Lukashenko himself is personally sanctioned now by the European Union, and you've also said that he has essentially given up the country into the hands of Vladimir Putin. What do you fear Vladimir Putin wants to do with Belarus now?
Now, Vladimir Putin uses the territory of Belarus as aircraft carrier for his military troops, and of course, we see that missiles and fate attacks are used, are going from Belarus, and the Russian air defense system is serving to Russia. Russian airplanes and helicopters take off from Belarusian airfields. It means that Lukashenko bears full responsibility for all events, and he lies when he says Belarus is not involved. He dragged us into this war already, and he is accomplice of Russia at the moment.
And of course, Vladimir Putin says that ultimately Belarus and also Ukraine, Russia, this is one people. That's his opinion. In your view, why is it important for countries like Belarus and Ukraine to break away from this Russian sphere of influence? Why is this so important for you to be independent?
The era of spheres of influence is already in past. We are unique, separate, independent countries with our own culture, language, and so on. And of course, people cherish our independence. We deserve to decide our future by ourselves, not by the order of the third country. Of course, people, our economics are very interdependent, but it doesn't mean that we should be ruled by Russia.
All right, thank you so much for joining us, Svetlana Tsikhanouskaya, their former presidential candidate for Belarus, and also thank you to our Maria Tadeo in Brussels. Now, we're just getting some breaking news, actually, out of the Polish Central Bank, set to intervene to support the zloty. This is something that, of course, we've been following quite closely. Any potential breaking news, the Czech Central Bank also saying that it is intervening to support the koruna. Our Valerie, of course, one of our markets reporters, reminding me that Czech, Poland, and Hungary are the liquid currencies in Central Europe, and they've hiked rates previously last year to get ahead of inflation. It will probably not be enough to prevent their currencies from devaluing now, and so we will see more intervention, very likely across the board. We'll continue looking, of course, at the fallout for some of these central bank and what they can or can't do given the very volatile situation. Futures in the U.S. still trimming some of the earlier losses. Again, Ukraine said a nuclear plant fire caused by Russian shelling of the area was extinguished. Investors awaiting monthly U.S. jobs data. Here in Europe, actually, we're though seeing quite a lot of selling. The latest escalation also sending commodities rising further. This is Bloomberg.
This chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Europe must wake up now. The largest nuclear power plant in Europe is currently burning.
As you can imagine, it is a very, very delicate situation where anything could happen.
If there's an explosion, that's the end for everyone, the end for Europe.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Europe's largest nuclear plant in East Ukraine comes under attack. The Ukrainian government says Russian forces now occupy the site. Wall Street is already pouncing on Russia's cheap corporate debt, while banks and hedge funds bid on bonds from Gazprom to Russia Railways. And stay with Bloomberg Surveillance Early Edition. This hour, we speak to the Lithuanian president, Gitana Nausėda. Send in your questions on IB plus TV Go. Now, first thing is first, let's check in on the markets. Now, we have seen quite a lot of volatility. We look at liquidity as well. Our Mark Cudmore had a great chart on liquidity, but we look at volatility because, of course, a lot of traders will have woken up to the fact that Russia was attacking a nuclear plant. Now, there was earlier a bit of confusion about whether it was uglier or could get worse than we thought. For the moment, of course, the fire has been extinguished, and we understand that it's occupied by Russian forces. And so we see a little bit of stability when it comes to the markets. European stocks still down some 1.7%. We did see a bit of a reversal when it comes to the futures in the U.S. because of that news. So if you look at S&P futures, they were actually only down some 0.3%. Again, that's on the back of the fact that we seem to have stabilized the situation at the nuclear plant. The other thing we're watching out for is, of course, U.S. jobs. Now, no one really cares about U.S. jobs that much, but still it gives us a good indication of what the U.S. economy is dealing whilst we, of course, freeze Russian assets. The other bigger story is commodities. We haven't seen a week in commodities like this in the last, I think, 30 years. So this will have implication for a lot of inflation update. And you can see the FTSE down some 1.3%. The FTSE MIB over in Italy down 2.5%. That is the CAC 40. So a lot to wade through when it comes to the markets. The implications, of course, on corporate bonds. A lot of corporate bonds from Russian companies that may not be sanctioned are going to be paid out, some of the coupons, in the next couple of days. We don't 100% know whether that money will reach some of the creditors or whether more sanctions are also to come. So we could see a potential default somewhere in the market. We're not saying it's happening, but something that, of course, we need to watch out for the second and third round effects. Now, Europe's largest nuclear power plant in eastern Ukraine has come under attack from Russian shelling, raising the stakes in Vladimir Putin's invasion as his forces bombard cities across the country. Now, Ukrainian authorities say the plant is now occupied by Russian forces.
Europe must wake up now. The largest nuclear power plant in Europe is currently burning. If there's an explosion, that's the end for everyone, the end for Europe.
Well, joining us now is Lithuania's President Gitana Nausėda and Bloomberg's Europe correspondent Maria Tadeo. President, thank you so much for joining us. First of all, given the horrific images coming from Ukraine, the shelling, the bombing, can Ukraine prevail in this war?
I think Ukraine will prevail.
in this war because the fighting spirit and the spirit in the society is so strong. And I'm pretty sure that Ukrainians as a nation are united about his leader, Volodymyr Zelensky. And our duty is to assist them, to help them to be so strong as they are so far. And of course, Russia is desperate, and we see what Russia is doing. Russia attacks on civil nuclear facilities in Ukraine. This is a crime. This is just a crime, nuclear terrorism, and I call on international reaction. First of all, Atomic Energy Agency should react to what is happening there. And I have to remind you that we have at the border with Lithuania, so-called Ostrovets nuclear power plant in Belarusian territory. So we could become the nuclear hostages because this nuclear power plant could be turned into nuclear weapon too. So this is going far beyond the behavior we could call the behavior of normal human beings.
And Mr. President, just to, of course, you made a very severe statement just there. Just to clarify, what you're saying is that Vladimir Putin already is doing war crimes and that what we're seeing, particularly around this plant, should be considered as terrorism. Is that what you're saying, just to make sure we get your words correct?
I can explain and I can tell very long sentences about what is happening, but I will call it nuclear terrorism because it's indeed nuclear terrorism of what we are witnessing right now.
And the fact that this is nuclear terrorism, I mean, how does that make you feel? We know that yesterday Emmanuel Macron had a call with Vladimir Putin and he came out of it believing that this situation is going to get worse in the next few days. So how can you deter further aggression? What we're seeing already is very ugly.
First of all, very strong response in many means, the full means. And first of all, we have to talk about even stronger sanctions on Russia. We have to stop to buy the oil and energy resources from this country. Lithuania is ready. Lithuania is ready to have alternative resources, alternative channels to buy crude oil from other countries, not from Russia. We are not dependent anymore on natural gas coming from Russia because we have LNG terminal in Klaipėda established. So those are the measures we took in the past, and they help us to just to be a part of this anti-Russian coalition, because this behavior is absolutely not tolerable, and we have to do everything in our hands to stop, to prevent Russia. And of course, we should talk about full disconnection of Russian banks from the SWIFT system. So far, we implemented some selective steps, decisions. They are not sufficient. Secondary sanctions for those who violate the existing ones. And I would like to say that there are countries which might help assist Russia to avoid the primary sanctions. This is also the matter of our discussion. I hope that next week we will have an informal meeting of European Council in Paris. And I think the big part of our discussion will be dedicated to Ukraine and those recent steps, recent decisions of Russia.
How will the war be resolved? The sanctions so far have been swift, they've been aggressive, they have not deterred President Putin. Will he stop at nothing in order to actually take over Ukraine?
But we can do more. First of all, we have to assist Ukrainians to withstand in this fight. And of course, we have to take all the measures, military, finance, economic. But yes, I agree with you that so far, because of brutality and because of very cynical approach of Russian government, unfortunately, those sanctions didn't have that impact we could expect. But it does not mean that those sanctions are ineffective, and we have to continue, and we have to press Russia to put it to the corner,
Mr.
to isolate from every organizations in the world, cultural, sport organizations, and this is happening right now.
And you say isolate Russia, but the Ukrainians say that what we should do, or what the West should do, by that we I mean, is to make Ukraine a no-fly area with all the risks that that carries. Of course, you have to enforce it. That means you'd have to have NATO planes flying over the country. Should there be a no-fly area over Ukraine? And if not, why are you not sending fighter jets for Ukraine?
This is good declaration, but how to implement this declaration practically? If Russian planes will violate this non-fly zone, what will be the instructions on the ground? So this is the reason why we have to assist them with modern air defense systems. But we should very carefully consider to step into the conflict directly. I am talking about NATO, I am talking about Western world.
Is NATO, Mr. President, doing enough to reassure the Baltic countries?
Sorry?
Is the NATO doing enough to reassure the Baltic countries?
I think we feel sufficient support coming, and not only in Ukraine, but also, as you mentioned, in Baltic countries, we see this support, and we see very decisive and immediate reaction. I recall the recent meeting of NATO summit in Brussels. I also see the efforts by Secretary General, Mr. Stoltenberg, to pay more attention to the whole region, to the whole eastern flank of NATO, because in the initial stage, there were discussions about Baltic Sea region, not Baltic Sea, but Black Sea region. But now we are in the process of paying more attention and taking more measures to secure and
Mr.
to increase.
President,
Yep.
And Mr. President, you say we've got to pay more attention, but yesterday at 3 a.m. in the morning, Zelensky in his telegram, he put up a video in which he said, if Ukraine fails, the Baltics are next. I know this is a very delicate question, but do you fear for the sovereign integrity of your country? I know it's very delicate, but what Ukraine say is if we're down, the next is the Baltics.
This is exactly the message I'm sending to my colleagues, to the leaders of Western world. Yes, maybe those will be the Baltic countries, maybe it might be Romania or other countries of Eastern Europe, but this is absolutely clear that if Ukraine falls, there will be a second target, and the third one, and so on.
All right, Mr. President, thank you so much for joining us. Lithuania's President Gitanas Nausėda, and of course our very own Maria Tadeo. Now we're also looking at live pictures from NATO. We have a lot of foreign ministers coming in as we speak. We just saw minutes ago, there he is, Secretary Blinken, saying that of course the U.S. is ready to act if something were to happen in the U.S. We also heard from the German foreign minister. The markets, I guess a little bit, more on tenterhooks, but less stress than they were a couple of hours ago. So U.S. stock indices futures still dipping as traders trying to assess the news out of Ukraine. Emergency services saying that a fire that broke out at a training complex at the nuclear plant had been extinguished and there were no injuries. We'll have plenty more, of course, on the situation on the ground and what it means for markets, business, and of course our economies as well. This is Bloomberg.
What do you think is the impact of the Prime Minister on the market?
As Mr. Suzuki, who is the Financial Services Minister, he mentioned at his own press conference, and share buybacks is widely used to return profits to shareholders and improve ROE. And how to share out the profits from growth is, totally the decision of the management of each company after carefully taking, all the stakeholders into consideration. And I believe Mr. Kishida has a quite cautious stance on the uniform regulation of share buybacks. And I think because he is giving a consideration to each company's, individual circumstance and, decisions.
Live pictures out of Brussels at NATO, where the meeting is just about to start with Mr. Stoltenberg. Of course, we heard him in a joint press conference, very brief, very to the point, with Secretary Blinken of the United States. Now, it does seem that NATO at the moment will not risk a border or broader Russia war. With, it's very difficult to impose, according to sources we've been speaking to on the ground, imposing a Ukraine no-fly zone. Now, the pleas, of course, out of Mr. Zelensky of Ukraine put the NATO in a very difficult spot, given its position that it's a purely defensive alliance. It has sent troops and equipment further east to reinforce countries close to Russia, but it's made clear that it will not send troops into Ukraine. We're, of course, keeping an eye on everything that's happening in Brussels and NATO. Now, to discuss the latest on the markets and on the economies, we're joined by Bloomberg's markets editor Christina Kino and Regina Borromeo, portfolio manager at Robeco's global macro team. So thank you both for joining us. Christine, if we do a roundup, so commodities have really been on a tear, and that has huge repercussions for inflation. I mean, the biggest commodity move in the last 30 years. Are you looking at that as, how much pain markets can get, or a possible default from a Russian sovereign or a Russian corporate?
Well, Francine, we have to keep an eye on all of these things for sure. Definitely. I mean, it started, of course, with the Russian assets on the ground and really getting a sense of how vulnerable they are at the start of this week. Then we moved on to the commodities aspect of it, because that has very big implications, again, for the broader inflation picture. This is part of the reason why we've seen bond markets, for instance, in such turmoil this week, because people are trying to make sense of that balance between growth and inflation. But now, Friday, we're turning to the FX market, because that's where the action is. We're just seeing interventions across Eastern Europe just before I got on set.
I know, with Czech and Poland. Let's also listen in to the Secretary General of NATO.
Opening of the meeting, and we will continue in just a moment. Thank you.
Okay, I cut you off, Christine, but actually it was just introductions. I mean, we are keeping a very close eye on this in case there's some kind of no-fly zone imposition. You're absolutely right. I mean, it's Czech and Poland, and basically there are three countries that have quite a lot of liquidity when it comes to currencies. Can they really defend them?
Well, Francine, that is going to be the big question. I think, again, any sort of intervention that happens right now will be a little bit like pushing a boulder up a hill, because they're going to be going against the tide of broad declines. I mean, this is something that we're seeing as well in the euro, for instance. We're seeing the euro this morning really extending those declines against a number of currencies, against the dollar, against the Swiss franc. And, this really lays bare just how exposed Europe is to this crisis. We've already seen it from the commodities angle, of course, and just in terms of proximity, geopolitically is very, very vulnerable. And we're now seeing this kind of really being shown in the FX markets as well, where, again, some of the big three East EU countries, as well as the euro, really getting battered in today's session.
Yeah, and Regina, I guess it changes everything. I mean, which is why it's so, difficult to try and understand the second round effects or third round effects, what some of the countries close to Russia will have to do to defend their currencies. Right now, how difficult is it for portfolio managers to actually assess the fallout from freezing Russia and the Ukrainian war?
Well, first off, we're really saddened by what's happening in Ukraine and the humanitarian tragedy that's happening in the region. But as global portfolio managers, we have seen, some repricing in the global fixed income space. Volatility is up, obviously, with the heightened geopolitical risk. But even with this repricing, we are cautious in being overweight risk right now. And there's several reasons for that. First is because, we are still seeing the U.S. Fed triple tightening. The last time we saw this in the last cycle, this took about over 4 years, and we're going to see this happen in the next few months. The second reason is obviously the fallout that we're seeing in what's happening in the Russia-Ukraine war. And, we're seeing this in an additional supply shock, and that's flowing through to higher commodity prices, higher energy prices. And this is going to dampen growth, also affect, keep inflation high, and really raise the risk of stagflation across the EU. And the other, sort of risk that, we're concerned about too is obviously the other ramifications, the unintended consequences of the sanctions, of the freezing of the central bank assets, as well as the SWIFT bank ban
so, Regina,
in the number of the banks.
Yeah, so what you're worried about, could we see a default in either a Russian sovereign or Russian corporate? And again, what does it mean for people invested in EM? Do you close positions and get out, or do you stay invested?
Well, that was my last risk that we are closely watching in the next several weeks, is because, we could see a Russian sovereign default in the next several weeks. Yes, the central bank already stopped coupons for domestic holders, and there is an external debt coupon that's due in the next two weeks, about $100 million. So this could be an environment where actually for investors, it's a combination of what we saw in 2018 when the U.S. Fed tightened further by decreasing their balance sheet, but also what we saw in 1998 where Russia defaulted and we saw the collapse of the hedge fund LTCM. And on top of that heightened geopolitical risk that we haven't seen since the 1930s. So this dynamic is, yes, very challenging. There's going to be high volatility, but as a global value investors, there are opportunities, but we are being patient here. We are positioning closer to home in many of our different sectors within our global fixed income markets.
Regina, one of the things that we're trying to figure out is also the vulnerability of European banks, even possibly of U.S. banks, to the exposure of some of these corporates in Russia or otherwise, some of the sovereign exposure as well. How long does it take for companies to have to come out with these disclosures? Are we talking about 2 weeks, or could we see something, someone big taking a hit in even a couple of months from now?
I think when you look at the non-financial corporate debt of the Russian corporates, it's about 1.3 trillion. So it's a decent size in a mix of both local and external debt. So the linkages there will take some time to flow through. So that's something that we are monitoring, because one is that you're going to have some volatility in the supply side, and then you're going to see the timeline of some of these coupon payments and debt maturities. I think there is a large maturity that's coming from Gazprom in the next week. So it's going to be interesting to see if there's going to be issues in repaying that external debt from Gazprom and more issuers from here. So, I think that's one of the reasons why, if you are an active investor such as ourselves, having large research teams in credit and high yield and on the macro side is quite important, because it is quite complicated. There's a lot of interlinkages and secondary effects to what we're experiencing today.
All right, thank you both for joining us. Our Bloomberg Markets editor, Christina Kino, and Regina Borromeo, portfolio manager in Robeco's global macro team. Now, as the West tightens sanctions on Russia and attempt to choke off investor demand for its assets, parts of Wall Street are actually jumping in on the buying opportunity that it's creating. Bloomberg understands that Goldman Sachs and JP Morgan have been purchasing beaten-down company bonds tied to Russia in recent days, while both banks have declined to comment. Joining us now is Bloomberg's Laura Benitez. Laura, what roles are the banks playing here exactly by trading in debt tied to Russia?
banks are acting as intermediaries, so they're buying and selling on behalf of their clients. In some cases, banks can also take on positions on their own books and package certain trades up and offer it up to clients to create opportunities. But I think it's safe to say that they're making markets at the minute.
So, given the war, of course, going on, is there any risk, or how can there not be a reputational damage risk here?
Of course, there absolutely is, and I'm sure there's conversations within the bank, within the different departments and how they manage that. I'm sure one argument that the traders and the trading desk will make is that they're in some cases helping clients de-risk and sell their positions. Of course, we know that's not the case across every circumstance that we've been looking at. They are bidding for some assets as well, so they are selling that on to create some opportunities. But I think one argument could be for them is that they're helping some clients at least de-risk and remove some positions.
So, Laura, how much trading is actually taking place? How much do we know about that?
So we know yesterday JP Morgan traded around $200 billion alone, and we had similar amounts for Wednesday. I think a little bit higher on Wednesday, actually, 300 million, which is way above the daily averages prior to Russia invading Ukraine. So there's a lot of volume going through, and the names that we're seeing being bought and sold are things like Gazprom, Russian Railways, a lot of sovereign debt as well is being bid for, and some other corporates as well. So it's quite wide-ranging. They're the main ones that we've been looking at.
So who's on the other side of this trade?
It's a good question. So we do believe from our reporting there are some big hedge funds stepping in. But obviously where that is still, a moving scenario, and we're looking into that. But as one fund manager in the story pointed out, this isn't the time to be looking for distressed opportunities, to be looking for opportunities at all. It's time to rip up that distressed playbook. This is a very difficult time. So I think the fact that hedge funds are stepping in is, creating a lot of questions. And it seems to be quite unsettling across the market for some.
All right, Laura, thank you so much. Great reporting, of course, from you and the team. Laura Benitez there, our European credit and high yield reporter. Now, in the meantime, let's also check back on the markets. We did see a bit of a wobble when it comes to U.S. futures. Stocks falling. U.S. futures also falling. War risks intensifying after this Ukrainian nuclear power plant briefly caught fire. Now, investors also await the monthly U.S. jobs report. The main question now is what happens to haven demand, apart from the possibility of Russia default either on a sovereign or corporate side, but Treasury is climbing amid this haven demand. Coming up, Russian forces occupy the nuclear power plant, so we'll get the latest on the ground. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you
You can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Europe's largest nuclear plant in East Ukraine comes under attack. The Ukrainian government says Russian forces now occupy the site. Wall Street is already pouncing on Russia's cheap corporate debt, while banks and hedge funds bid on bonds from Gazprom to Russia railways. Plus, Eastern European central banks intervene in their currency markets. We'll speak to Goldman Sachs economist Kevin Daly. Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the market's definitely volatile this morning after traders tried to understand the situation in Ukraine with Russian forces taking over that nuclear plant. What we're looking at right now is a bit of stability when it comes to U.S. futures. The European stocks 600 actually in deeper territory. When you look at some of the things on the move, it's auto parts that are falling the most. Again, as the Ukrainian war escalates, traders really trying to understand what it means for havens. Treasuries climbing amid this haven demand, whilst oil set for its biggest weekly surge in almost 2 years. I'm also looking at the dollar ticking up and the euro slipping. Now, Europe's largest nuclear power plant in eastern Ukraine has come under attack from Russian shelling, raising the stakes in Vladimir Putin's invasion as his forces bombard clients across the country. Well, cities across the country. Ukrainian authorities say the plant is now occupied by Russian forces.
Europe must wake up now. The largest nuclear power plant in Europe is currently burning. If there's an explosion, that's the end for everyone, the end for Europe.
Well, we're now joined by Bloomberg's Aggie Cantrell, who's at the Medica border crossing in southeast Poland with the very latest on the ground. Aggie, what do we know?
Hi, Francine. So what happened at this plant yesterday was essentially that there was a fire in a training facility at the plant. They stressed that there was no nuclear part of the facility that was at risk from this. But now that the Russians have occupied it, it is important to note that this is something that's going to continue to be a concern to people as a country with 15 nuclear reactors is currently at war.
All right, Aggie, thanks so much. We'll have plenty more, of course, on the ground from Aggie Cantrell. Now, we're joined by Kevin Daly, co-head of CEMEA Economics at Goldman Sachs. Kevin, as always, thank you so much for joining us. We had a couple of minutes ago, of course, that story with the Polish Central Bank said to intervene to support zloty. I think we have a similar story, of course, in the Czech Republic. How much support do these currencies need in the shorter term?
Well, it's facing a very large dilemma. Each of these central banks have been very clear that they need currency strength to bring the already very high rates of inflation under control. The fact that you've seen these very dramatic sell-offs, depreciations in their currencies is making their task all the harder. You know, inflation, as I say, was already running at double-digit pace before this crisis. This is the combination of FX weakness and also, obviously, the very large commodity price increases will add to the burden of these central banks to bring inflation under control. So, you know, we think potentially quite material FX intervention going forward.
But Kevin, do they have the treasure troves to be able to do this? I mean, this is, you know, to be able to try and mitigate some of the excessive fluctuation. How much do they have to spend on this?
I mean, they do. I mean, they've ample reserves, and I think what you will see over time, in fact, what we are already seeing is further interest rate rises in response. Hungary yesterday raised the deposit rate more than was expected. We would anticipate that Czech and the Polish National Bank will implement further interest rate increases over time. We've as a result of the conflict, have raised our interest rate forecasts for these economies. So I think it will be a combined effect of both raising interest rates further than markets previously expected, but also intervening in the currency as well.
Kevin, I know there's not that many currencies that are actually liquid in the region, apart from these two and maybe the foreigns, but will it impact many more central banks and many more countries?
This is a very inflationary shock across, not only across the region, across the world. And bear in mind that our Russia economist in our forecast, we expect Russia GDP to fall by 7% this year, but that assumes that the export of commodities can continue relatively unconstrained. In the event that those are also cut off, then the hit to Russian GDP would be greater. The rise in commodity prices globally would be even stronger than we've seen already. So this is potentially very worrying for central banks. Bear in mind that even before this conflict escalated, they were already facing very high inflation rates because of the impact of COVID. So this is a double whammy for central banks across the region.
Yeah. Kevin, we're also just getting a briefing, which I think just started minutes ago, from the International Atomic Energy Agency. So we're keeping, of course, a very close eye on what they think the repercussions for this nuclear plant attack. We understand that, of course, the fire has been contained, but there was a lot of stress in the markets to try and understand if other nuclear plants are attacked, what this means. The IAEA chief briefing the press on this power plant. We'll keep a very close eye on what he's saying. Actually, let's listen in.
Nuclear power plant, where we have contacts at the moment and permanently through the night. So, as you have been informed, overnight, projectile hit a building within the plant site, within the site of the plant. This building, I should repeat, is not part of the reactor, is none of the reactors, is a training adjacent construction facility to the reactors. This caused a localized fire, which was extinguished by the local fire brigade at the plant. So it's important to say that all the safety systems of the 6 reactors at the plant were not affected at all, and that there has been no release of radioactive material. No release of radioactive material. Importantly, in this regard, is the radiation monitoring systems. So the systems we have to measure the radiation are fully functional as well. However, as you can imagine, the operator and the regulator have been telling us that the situation is naturally continues to be extremely tense and challenging because of the circumstances. Of the plant reactors units, one must say that of all the units that we have there, there's only one that is operating at around 60% of its capacity. Unit 1 was in outage for maintenance. Units 2 and 3 are in safety controlled shutdown. Unit 4 is the one that is still operating at 60%, and units 5 and 6 were already being held in reserve.
We'll continue, of course, following that press conference from the International Atomic Energy Agency to try and understand what the occupation of Russian forces on this site of the nuclear plant, as the fire has been contained, means longer term for the security of nuclear and the nation. We're back with Kevin Daly, a co-head of CEMEA Economics at Goldman Sachs. Kevin, I know it's extremely difficult to react, of course, to this nuclear plant situation, given we don't know at this point the ins and outs and exactly what it means for the control of energy. But if you look at that part of the world, is a market too sanguine that will be able to freeze out Russia, a neighboring country, the 11th biggest country in the world, without huge repercussions? What's the possibility of actually sanctions, firing back, especially for some of these smaller nations on the border?
Well, I mean, a major concern for us is that it isn't easy to see a near-term resolution to this conflict. I mean, on the one hand, even if Russia, the Russian forces win militarily in the coming weeks, and that's far from certain, but even if they do, their ability to maintain authority over a country of Ukraine's size and population will be very difficult. And yet, set against that, for the Putin administration to back down at this stage would involve a significant loss of face, of reputation and authority for him. So it's very difficult to see him backing down in the near term. So we are concerned that this, the crisis is likely, the conflict is likely to get worse, and we don't see any near-term resolution.
Kevin, going back to some of the foreign exchange intervention that we saw from Poland and the Czech Republic, I know you've put out new forecasts. Are they already out of date, given the situation is moving so fast?
I mean, the situation is moving very fluidly, as you say. The commodity prices, even in the couple of days since we've put out revised forecasts, commodity prices have continued to rise further. Exchange rates for the CE economy, so Poland, Hungary, Czech, have continued to depreciate, even in the face of the interventions announced today. So yeah, we've raised our interest rate forecast. We expect a peak of 5.5% across the region. I think now that the risks are skewed very much to the upside relative to that, these central banks are likely to have to continue to raise rates and raise them significantly in order to bring both their currencies and inflation under control.
Kevin, thanks so much. Kevin Daly, there, co-head of CEMEA Economics at Goldman Sachs. Now, we'll have plenty more, of course, on all of this. We'll have more on Wall Street, reportedly pouncing, also on cheap Russian corporate debt. That's coming up shortly, and this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. We continue following that press conference from the International Atomic Energy Agency. Of course, the head of that agency, the Director General, saying that Ukraine sent requests for immediate nuclear assistance to the IAEA. We understand for the moment that Russian forces are occupying that nuclear plant. The fire that had been started is now contained, and the IAEA has offered to mediate talks between Russia and Ukraine straight away. Now, you can continue watching that press conference on the Bloomberg terminal on LIV Go. Now, let's get more on our story. Also about Wall Street banks scooping up distressed Russian corporate debt. Bloomberg understands that Goldman Sachs and JP Morgan have been purchasing beaten-down company bonds tied to Russia in recent days. Well, joining us now is Damien Sassower. He's our Chief Emerging Markets Credit Strategist at Bloomberg Intelligence. Damien, as always, thank you so much for making the time for coming in. When you look at that story about some of the possible defaults in sovereign Russia, in corporate Russia, but also now some of the currencies, including the Central Bank of Poland and the Czech Republic, having to intervene in currency markets, where's the biggest default? Like, what are you worried that could turn ugly in a short amount of time?
Well, I mean, to unpack it all, and there's plenty to unpack, Francine, I mean, we have to start this weekend. We're going to see some coupon payments from Gazprom and Rosneft. They're minor, but really, at the end of the day, that's the beginning. Gazprom owes a $1.3 billion principal payment on Monday. Look, the funds are supposedly at the settlement bank, ready to be paid, but we'll see if they actually make payment. I'm suspect on that one, you know, and CDS is pricing in a very high probability of default either way. So, you know, the reality is, you know, looking at Eastern Europe, to your point, you know, the interventions, I'm not at all surprised. You know, basically the Czech Republic, the Hungarian forints, the Polish zloty have all gotten absolutely smashed. The one safe haven within the CE4 has been Romania. The Romanian leal has actually tracked the euro quite well. So, you know, it's still down, but not down nearly as much. So, you know, I mean, if you then look at the Wall Street story and you look at JP Morgan and Goldman Sachs buying distressed debt, distressed Russian debt, look, that's a strategy which has historically proven quite profitable, looking back to '98, looking back to some of the previous crises we've seen. You know, many of the largest emerging market distress funds today, Gramercy comes to mind, Greylock, which is, you know, another one, you know, they made their bones in 1998, you know, Damien, picking away. So, yeah.
When you look back again, and you're right, let's take a step back because we're trying to unpack a lot because the story is so fast moving that if you're a trader, I mean, you either, you know, hide under your desk or you try and figure out what happens next. First of all, if Gazprom, I think there's also Rosneft, having to pay a big coupon, in order for them to do that, they're not sanctioned. In order for them to do that, do they just need to have dollar reserves outside? Yeah. And is it possible that they have that, but it doesn't actually come to the creditor because of some of the, you know, auto sanctions or just the sanction on some of the banking system?
I mean, that's certainly possible. You know, I mean, obviously the mechanics of how that money actually needs to get paid to the underlying investors, but the money is offshore. It is there, and they can make the payment from what I understand. So, you know, you know, it remains to be seen what the mechanics are, whether or not a clearing bank is going to prevent them from doing that at this point, Francine.
Okay, if a JP Morgan or a Goldman Sachs goes after some of this debt, given the toxicity and the fact that, frankly, Russia is now a financial pariah, is there going to be so much reputational damage that you're just going to have to banks saying, like, look, I can make a deal here, but it's just not worth it?
Well, I think really if they're acquiring this debt, they're acquiring it probably from other U.S. investors, right? I think really at the end of the day, we have to think about what this means for your ETF holder, your average retail investor here in the U.S. You know, Russian bonds, Russian equities have been kicked out of every index on the planet right now. I'm talking JP Morgan, Bloomberg, FTSE, MSCI, equities, bonds, you name it. So what do? I mean, if these bonds are still sitting in a portfolio inside of an ETF, you have to ring fence it, and you basically have to create a different structure now. Whether or not you can sell those bonds through to the dealing bank or what have you remains to be seen. I'm assuming JP Morgan and Goldman Sachs are maybe putting a bit of that on their balance sheet, you know, wearing a bit of the risk alongside their investors in the hope that they have a long time horizon, and this will get worked out in time.
All right, Damien, thanks so much. Damien Sassower, Chief Emerging Market Credit Strategist at Bloomberg Intelligence, actually stays with us, and we'll come back to him at some of the neighboring countries. I want to look at Poland, Damien, and I also want to look at the Czech Republic. In the meantime, we still have that important press conference from the UN Atomic Agency saying that there has been no radiation release at the Ukrainian plant. Mr. Grossi, of course, the Director General, also saying that they are apolitical and they have offered to meet Ukraine and Russia at Chernobyl. They also reiterated the fact that Ukraine had sent a request for immediate nuclear assistance to the IAEA. We now understand that Russian forces occupy the site of this nuclear plant, but the fire that really was extremely concerning to everyone involved is now contained. You can watch that press conference in full on LIVE Go. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Good morning, Francine. Commodities are closing in on their biggest weekly gain since 1974 as importers and shippers steer clear of Russian exports following its invasion of Ukraine. Brent crude briefly soared above $120 a barrel yesterday before pairing gains, while aluminium hit a fresh record and zinc topped 4,000. Now, wheat prices have soared to their highest level since 2008 on mounting fears of a global shortage. That's as a war in Ukraine shuts off over 25% of global exports of the staple used in everything from bread to noodles. Russia and Ukraine are also major suppliers of corn, barley and sunflower oil. Corn has risen to the highest level since 2012, while soybean oil and palm oil have also reached records. And that's your Bloomberg Business Flash. Francine.
Leanne, thanks so much. Coming up later today on the U.S. Jobs Report, we'll speak with the U.S. Labor Secretary Marty Walsh. That's at 9:30 a.m. in New York, 2:30 p.m. in London, and this is Bloomberg.
Is this going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And, you know, if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project, initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the angstrom era when we're going to 2 nanometers and below into the angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Now to talk about emerging markets, still with us, Damien Sassower, Chief Emerging Market Credit Strategist at Bloomberg Intelligence, and also joining us, Bloomberg's Markets Editor, Christina Kino. So thank you both for joining us. Damien, first of all, you're doing a lot of research on something that hasn't really been noticed or investors have not had the time to look through, which is if you look at the UN Security Council and the countries that have abstained instead of voting no to a resolution, a lot of them, of course, are emerging markets. What does it mean for their long-term investability?
Right. No, there's a lot to unpack there also. I mean, Francine, what stands out to me is if you look at 2014, when the UN had a vote on the annexation of Crimea, a lot of the historically Russian-tied countries, I'm thinking Armenia, Zimbabwe, Sudan, Bolivia, Nicaragua, they all voted no. This time around, they abstained. So that's kind of a good thing and shows the world coalition coming against Russia. On the other hand, you've got countries like South Africa and India, which have abstained and didn't really vote yes. I mean, India, as we know, is one of the Quad. In fact, I think President Biden's scheduled to speak with him this weekend. So, Modi, I mean, this is his time on the world stage, and for them to abstain, granted, we know that they rely heavily on Russia for military. They're fighting a bit of a proxy war along the western border with the northwestern border with China. So, again, there's a lot to unpack, but South Africa really stands out. I mean, why wouldn't South Africa, this bastion of freedom on the continent, vote yes? And, there's a lot to unpack there also. I don't think we have enough time.
No, I mean, we could do actually a whole 1 hour, 3 hour show just on this. And Christine, the other thing, if you look at emerging markets, is a lot of them, of course, are either commodity rich or very dependent on commodities. Commodities in the last week, I think we've never seen anything like in the last 30 years.
Absolutely, Francine. And so you've already seen that process starting for investors trying to hunt for which emerging markets are really potentially set to benefit from this boon because, we're talking about investors trying to find any sort of haven within the EM space from Russia, trying to carve out some spaces where they could potentially get some gains here at a time when risk aversion is really at quite an astounding peak. And so, all of these kind of resource-rich countries very much getting the attention of investors.
Damien, we are 7 days into those sanctions and really trying to freeze out a huge G20 country. Who will suffer the most in terms of country?
Well, I mean, obviously,
apart from Russia.
Well, Central and Eastern Europe is front and center, and we've seen the currencies. We've seen the krona, we've seen the forint, we've seen the zloty all get smashed. I mean, that is front and center. Those are three of the largest, most investable countries in the emerging market universe. Obviously, the Baltics are in play as well. They have a lot of hard currency sovereign credit, which is at risk. Let's be clear. Belarus, Russia, and Ukraine combined over the last week alone, their U.S. dollar bonds have lost $24 billion in market value for their dollar creditors. I mean, that's a huge number. I mean, it's not on par with Argentina back when they defaulted, but it's pretty significant. So the losses are building. And what we're seeing, if you just look at options on the world's largest emerging market bond ETF, the BlackRock iShares, EMB, basically option volumes are through the roof. Tons of put buying, investors buying protection, and so it's a big number.
In 5 seconds, are emerging market portfolio managers now changing their allocation?
I think they're just assessing the risk, Francine, to be honest with you, and I think that's where we are. I think it's basically a function of what comes next, and what comes next means we are seeing prices consolidate here. There may be a buying opportunity potentially.
Damien, thank you so much. Damien Sassower, Chief Emerging Markets Credit Strategist at Bloomberg Intelligence, and thank you as well, Bloomberg's Markets Editor, as always. By my side, Christine Aquino. Now, we're also looking, of course, at some of these Russian forces having occupied the nuclear power plant. We'll have plenty more on that. Anna Edwards, Danny Berger, Matt Miller. This is Bloomberg.
nuestro estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor, y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las mediciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Lots happening on Wall Street. It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Europe must wake up now. The largest nuclear power plant in Europe is currently burning.
It is a very, very delicate situation where anything could happen.
It's one of those fratricidal situations that nobody, not even Vladimir Putin, should wish for.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Friday, March the 4th. Our top stories today. Ukraine says a nuclear plant in the east came under attack and is now occupied by Russian forces. The incident is raising the stakes in President Vladimir Putin's invasion as his troops pound cities across Ukraine. Stocks fall and futures signal more losses for Wall Street as the historic week in commodities also sends shockwaves around the world. And later today, the U.S. jobs report will be front and center. Bloomberg Economics expects a solid pace of hiring, confirming Fed Chair Jerome Powell's assessment that the labor market has plenty of room to withstand rate hikes. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards with Danny Berger here in London and Kaylee Lines in New York. Matt Miller is off today. And Danny, we should point out that fire referenced in that opening sequence, it has now been extinguished. It was in an ancillary building to the actual reactor in Ukraine that was hit during this shelling by Russian troops. We got comforting words also from the IAEA, but none of that enough to lift the negative mood, the negative sentiment, the risk-off mentality we have for European stocks right now.
Well, it is a jittery market, Anna. It has a lack of liquidity, and that's leading to these jolts that we're getting in markets. And look, Asian markets are no exception. This morning, Asia was, of course, up and trading when those headlines hit of the attack on the nuclear plant. In the span of just 30 minutes after the headline crossed, we saw the MSCI Asia Pacific Index dive 1%, again, in less than 30 minutes. So it was a stark reaction, ending the session down some 1.7%. Now, Hong Kong fared even worse. It also was fed into this very risk-off day, but also local problems there as well. The economy seeing really weak data, activity the lowest in 22 months, given that they're dealing with the worst COVID outbreak in the city's history. And when it comes to what's doing well in the Asian session, it's things tied to commodities like the Aussie dollar, the best G10 performing currency today, and so far this week up 2% versus the dollar as those commodity prices look to book their best week since the 1970s. And finally, Kaylee, I think it's interesting to mention the yen really not acting acting as much as a haven. It does feel like it's all about the dollar to help protect against these risks.
Yeah, Danny, that's absolutely right. The Bloomberg Dollar Spot Index at the moment is trading at its highest going all the way back to July of 2020. As for how the picture looks like for other U.S. assets outside of the dollar, it really has been a wild session, just like it was a wild session in Asia, as Danny was telling us about. You had futures down sharply on news of that attack on the nuclear plant in Ukraine. Then the news that the fire extinguished brought futures up actually into positive territory just briefly, but we were once again heading south with S&P E-minis down by about 0.8%. In the bond market, yields had broken below 170. We're back up around 178 at the moment, but still down the better part of 6 basis points on the day. When it comes to oil, that has been a lot of volatility really across the commodity complex over the last week or really weeks. Right now, WTI crude up 1.3%. We're trading around 109. We've been dancing around 110 on WTI for many days now. And then just pointing to Bitcoin trading in tandem with other risk assets, it is lower after a big drop yesterday, down 1.3%. We're trading around 41,500, Anna, but of course there's a lot of scrutiny about how cryptocurrencies may play a role in getting around sanctions when it comes to Russia. It's something we heard Senator Elizabeth Warren talking about in Senate Banking Committee hearings yesterday, Anna.
Yeah, absolutely. Something we continue to follow. Kaylee, let's get to the European story because certainly jittery, as Danny described it, is appropriate. Very nervous European markets this morning, down by more than 4% on the FTSE MIB. Gives you a sense of how some of the more geographically peripheral markets are performing today. Down by 3% on the FTSE 100. And we don't necessarily have the strong support of higher oil prices to lift us higher in the London market, which is something worth noting today and something a little bit different to risk aversion days we've seen in the past, maybe. Some of the sectors, well, no sectors really in Europe doing anything very positive today, but one of the sectors most beaten up is the stocks, the auto stocks, down by 5.6%. This is a sector, of course, that's struggling to cope with its exposure to Russia. The supply chain issues had already been an issue even before this war started, and now you add on top further supply chain difficulties and whether they should or should not be supplying to the Russian market itself. The euro, interesting to watch. Dollar strength has been the haven of choice today. Money into the dollar has been the real story, but 110.14 on the euro. So we are seeing some weakness coming through in the euro, and I'm increasingly reading stories about whether parity is back on people's radar. We haven't been down there since the beginning of this century. Could that be something that the market starts to talk about? I spoke to 2 guests this morning saying it's absolutely not their base case, not what they're thinking about right now. Brent crude, $111 a barrel. So such is the volatility this week, down at 98 at one point, up at 119 at another. Such volatility, but only up by less than 1% in today's session. But we are seeing substantial moves higher on natural gas prices. This is the European benchmark, up another 8.7%. Not quite at those highs, but not far from all-time highs on those natural gas prices, really reaffirming our focus on this as one of the key indicators of stress and, of course, economic worry and economic concern to come for Europe, Kaylee.
Absolutely. We'll continue to monitor the economics today because we have a big economic event in the day ahead. Before we get there, though, in terms of politics, France will also be publishing its final list of presidential candidates, and Emmanuel Macron, of course, announcing he will seek another term. At 12 p.m. New York time, Apple will be holding its annual meeting of shareholders. But as for that big economic event, I think we all know what it is. We will get the U.S. jobs report for February at 8:30 a.m. New York time, Danny.
Kaylee, let's start today with our top story, with Russian forces having occupied the site of Europe's largest nuclear power plant after an attack that ignited a fire at the complex. It raises the stakes in Vladimir Putin's invasion as his forces bombarded cities across the country. The IAEA Director General spoke earlier.
For the time being, it is purely Ukrainian staff running the operations there. What we have in this case, as we speak, this morning at 10:45, what we have is in Chernobyl and in Zaporozhye, we have effective control of the site in the hands of Russian military forces.
From the Polish-Ukrainian border, we're joined by Bloomberg's Aggie Cantrill. Aggie, it seems that the fire has been extinguished, but bring us up to the latest state of play at this nuclear site.
Hi, yes, so as you say, the fire has been extinguished, and it must be stressed that this fire broke out in a training facility in the plant, and Ukrainian authorities have said that no nuclear material was affected by this fire, but it is now being reported that it was in the occupation of Russia. And what this is significant, what is the significance of this is essentially that we're seeing a country with 15 functioning nuclear reactors that is currently dealing with a ground war. This is something that President Zelensky said was a wake-up call to Europe, because should there ever be any issue with these plants during this conflict, that would not just be an issue for Ukraine, it would be something that would impact the entire continent.
Okay, just looking at images of the Zaporizhzhia nuclear power plant that has been shelled then by the Russians, resulting in that fire, Aggie, that you described, that you mentioned, and has been extinguished now. It was, as you say, rightly not in the reactor. It was in a training facility nearby. And we also should mention that we're being told there's no elevated radiation levels at the site. Can you tell us, though, in Ukraine more broadly, what is Russia's progress now? We hear a lot about the advance in the south, more so perhaps than progress around Kiev.
So this nuclear reactor is actually just is about 200 kilometers up the Dnipro River from Kherson, which is on the Black Sea coast, which is where Russia has managed to gain a bit of a stronghold, as well as obviously in the eastern separatist regions. But what's important to note now is that you see behind me, there are still flows of refugees coming into Poland and other Eastern European nations from Ukraine, because this is not just something that is affecting the Ukrainian military versus the Russian military. These are a lot of civilians that are now being affected by the conflict itself.
All right, great reporting from the Polish-Ukraine border. Thank you so much to our Aggie Control. And of course, we'll have more on Ukraine later this hour with our Maria Tadeo in Brussels. But first, we want to get over to Washington, D.C. President Biden spoke with Ukrainian President Vladimir Zelensky as reports of the nuclear plant attack emerged. Meanwhile, the White House is objecting to banning oil imports from Russia. Emily Wilkins, Bloomberg government reporter, joins us now from D.C. So, Emily, the administration is against this, yet you had the likes of House Speaker Nancy Pelosi yesterday saying that she would support a ban on oil imports from Russia. How stark is the divide between the White House and Capitol Hill?
I mean, there definitely is a divide. Let's just be clear, though. I mean, even though House Speaker Nancy Pelosi has said that she would be for the ban, this isn't where all Democrats are. So there's not like a complete divide between President Biden as well as congressional Democrats. And the White House explained it. We heard, yesterday they said that they just don't have the strategic interest in reducing the global supply of energy. They are very worried about that, what that would do to gas prices for Americans. Obviously, Americans are already dealing with very high inflation. And so that so far has been the White House's interest going forward in trying to really strike that balance between doing what they need to do in terms of sanctions, but also making sure that the impact on Americans is minimal.
Emily, there have been more sanctions put in place, though, as that one gets debated. But what is being done when it comes to direct support for Ukraine?
So Congress is currently talking about a $32.5 billion in aid. That was a request from the White House. And this has been a number that's gone up over time. We initially heard about $10 billion. Now we're hearing this $32.5 billion number. It's not clear exactly when that aid would pass, but we do know that Congress is currently working on a bill to fund the government by March 11th, so just next week. And there's really a strong bipartisan desire on Capitol Hill to do what can be done to help the Ukrainians at this point. And so while we don't know, of course, what the final number is going to be, how that's going to differ from the White House request, you're really seeing a lot of strong bipartisanship around this issue. You'll remember at the State of the Union earlier this week, a lot of bipartisan applause for lines from the president on assisting Ukraine.
Emily, thank you very much. Emily Wilkins, our Bloomberg government reporter there with the latest from Washington. Now, as the West tightens sanctions on Russia, parts of Wall Street are jumping on the buying opportunity that it is creating. Bloomberg's learned that Goldman Sachs and JP Morgan have been purchasing beaten-down company bonds tied to Russia in recent days. Both banks have declined to comment. Kriti Gupta, Bloomberg Markets correspondent, has more on this Bloomberg scoop. Fascinating story then, Kriti, which has both a financial and a political angle to it, perhaps.
It absolutely does. Well, think about the point of sanctions, right, Anna? The idea that you do have to actually kind of make these assets essentially uninvestable. That's the end goal of these sanctions. And it's kind of worked. Take a look at what some of those dollar bonds are doing for some of the major state companies where you did have a lot of those EM investors have a stake. They are now worth about 35 cents on the dollar on average. For a radio audience, essentially, it's a line and then it's a steep drop. It tells you just how quickly these moves have been made. And it's not just in the bond market where you did see JP Morgan actually say it's been working with about clients for about 200 million in corporate debt from Ukraine and Russia. But it's happening in the stock market as well, where you have these enormous moves when it comes to some of these ADRs for Russian banks. Gazprom, for example, the ADR is down 62% year to date. Lukoil as well, down 93% since the start of the year. And Sberbank, which of course is the largest consumer bank in Russia, now down 97% since the year started.
Some massive moves. Thank you so much to Bloomberg's Kriti Gupta. And of course, for our radio listeners, if you want to see Kriti's great chart, you can just type GTV Go on your Bloomberg terminal. Meanwhile, Fed Chair Jerome Powell reaffirmed yesterday that the U.S. Central Bank is on track to hike rates this month. He spoke before the Senate Banking Committee.
I would be recommending and supporting a 0.25% interest rate increase at our March meeting. If we don't see inflation behaving as we expect it to behave, which is to peak and begin to come down, if we see inflation behaving in ways not consistent with that, then we're prepared to raise by more than that amount in a meeting or meetings.
That was Fed Chair Powell speaking yesterday, and he and investors now are awaiting the U.S. jobs report out later on this morning. Michael McKee, Bloomberg International Economics and Policy Correspondent, here with us for more. Mike, what are we expecting?
Well, you know, with the news that you've been reporting this morning, people on Wall Street are saying today is NFP day, not non-farm payrolls, but not focused on payrolls. And that's going to be the story of the day. With so much news going on over in Europe, the payrolls report isn't going to have much of an impact on a Fed that has already decided what it's going to do in March. We're looking for 423,000 jobs. It would tell the Fed things are still going okay in the U.S. economy. Unemployment drops a little bit. They'll watch average hourly earnings, but they know they have been going up as long as they don't go up much more than what we're forecast. This is the thing that people are going to be watching at the Fed, not because of the March meeting, but they want to know, when does the rest of America come back to work? Were people off work because they have been worried about COVID? And if so, has that drop off in the COVID case rate started to bring people back? And that's the participation rate that everybody is looking at. And we're looking to see if it goes up during this, if it went up during February. For those of you watching on radio, I have a chart here that shows the participation rate here in white is the prime age workers, the 24 to 54-year-olds, and that has been high. It's at 82. It's supposed to be, well, before the attack, it was at 83. That's 1.3 million jobs still left to return. The only category that's come back strong are the old guys, over 54. And we hope that the younger people will get back to work as well. And maybe next month we'll be paying more attention to the jobs report.
All right, NFP, not focused on payrolls. That's our acronym for today. Thank you so much to Bloomberg's Michael McKee. Now to get back to some of the micro stories, take a look at some stocks moving in pre-market trading this morning. A big one to the upside is Gap, of course, the retailer. It reported after the bell last night better profit outlook for the year than expected. It says its strategic turnaround starting to pay off. That stock is up about 7.5% before the bell. Another upside mover is Raytheon Technologies. You're seeing defense getting a little bit of a lift with the war ongoing in Ukraine. It's up about 2%. To the downside, though, basically all of the cruise lines are lower in early hours, one of them being Carnival, which announced yesterday it is starting to change some of its itineraries to avoid the port of St. Petersburg. Not a lot of people, I guess, want to cruise to Russia at the moment, and especially given all the sanctions going on, it could complicate that situation. So that stock is down about 5% before the bell, Anna.
We just saw Mike McKee making a speedy exit from the studio. No doubt he didn't want to miss any of our next conversation, Kaylee. We'll be talking to Steve Blitz, T.S. Lombard, Chief U.S. Economist. Lots to discuss. We've heard a lot from the Fed this week. How much of that has cut through? How much will the payrolls cut through, given everything else we're dealing with here on markets? And thinking of the geopolitics, thinking of the tragic situation in Ukraine itself, we will talk to Wolfgang Munchau, Euro Intelligence President, here to talk us through all the politics as he sees it. Plus, on that jobs report, we will be speaking to the U.S. Labour Secretary later, Marty Walsh. That's at 9:30 a.m. in New York, 2:30 p.m. in London. This is Bloomberg.
U.S. has announced it's moving 8,500 more troops to Eastern Europe. If they're not being deployed to Ukraine specifically, why is that so important, and does that risk further provoking Russia?
Well, there's two things going on. So what the United States recently announced is that we are going to put 8,500 troops that are part of the NATO response force on high alert. That means they'll be ready to deploy on a moment's notice should we need those forces anywhere in Europe to protect NATO territory. In addition, the United States is also looking at possible additional moves that they might make to move U.S. force posture into Central and Eastern Europe. The reason we're looking at that is because a lot of the members in that neighborhood in Central and Eastern Europe feel concerned. And so we are looking at what measures we might take in the name of reassurance and deterrence.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds. Last month's jobs report caught everyone off guard.
A massive upside surprise.
Just an astounding number.
The most stunning miss I've ever seen.
This Friday, count on Tom, John, Lisa, and Mike to get you the numbers and analysis you need fast.
A labor market that looks increasingly tight.
The economy is shaking off this pandemic.
And that's going to continue to keep the pressure on the Fed.
The February jobs report. Everything you need here on Bloomberg Television and Radio.
This is Bloomberg Surveillance, the early edition. Now, earlier today, the Moscow Exchange reported that they would keep their exchanges for all assets closed at least until Tuesday. So you now have a market that is illiquid and untradeable and valued at zero. But what are the contagion possibilities? Well, we are starting to see signs of stress, specifically U.S. dollar funding stress. For a radio audience, I have the FRA OIS spread. Essentially, this is the spread between funding overnight versus 3 months. Usually, it's around zero. But the stress in this market means that this spread has widened more than 15 basis points on the week, getting to those 2020 levels. So how stressed out is this market? Let's get to Lynn Thomason, Bloomberg Markets Managing Editor. Lynn, how widespread is anxiety in this market currently?
I think anxiety is everywhere.
All right, I think we are having some audio issues. Apologies for the technical difficulties. We will be getting back to our markets conversation. This is Bloomberg.
The Omicron variant and the latest wave have an impact on not only consumer trends, but your business. And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida.
And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger with Kaylee Lines and Anna Edwards. Now let's get back to our conversation with Lynn Thomason, our EMEA Markets Managing Editor. Lynn, sounds all back on, so let's get back to it. We're just talking about anxiety in this market. Now that you are loud and clear, where are you seeing it most pronounced?
There we go. And there's plenty of the anxiety in the market. Where is it most pronounced? I mean, I think it's really across the board in all risk assets. You're seeing a flight to safety. And, you know, I think really the most remarkable move this week has been in commodities. Oil, agriculture, metals, all going through the roof on the Russian news. And, you know, it just seems like things are heading higher from here.
Right, okay, so commodities certainly has been a big focus for us this week. Also a big focus then, Bank of America and their latest data on where flows are heading and money coming out of Europe. I mean, you just have to compare US futures, down but not out, with European stocks, which are substantially hit this morning, to see that in action.
Yeah, absolutely. And I think what you're seeing from markets is, you know, traders are saying, how are we going to trade this? And clearly, you know, Europe and the fallout from Europe, and what are some of the impacts? It's going to affect this region more than perhaps, you know, the US and Asia. So you're clearly seeing European equities get the hardest, and that's being reflected in the outflow data.
Lynn, just quickly.
Lynn, thank you very much.
Sorry, Anna.
Apologies, just up against a hard break. But Lynn Thomason, thank you very much for joining us. Still to come on this program, Steve Blitz, TS Lombard, Chief U.S. Economist, will be with us. We'll talk about everything we've heard from the Fed this week. We'll talk about the fundamentals of the U.S. economy. What data updates have we had this week on that front? And does that give Steve reassurance about where the U.S. economy goes from here, even if we see the U.S. economy's growth trajectory hit by what's happening in Ukraine, tragically on the ground? Does that mean that, where does that leave the U.S. fundamentals? We'll get to that conversation shortly. We'll also talk about the non-farm payrolls data, which is due to be released later on today. But with all that is going on in Ukraine, how will that cut through? This is Bloomberg.
know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Ukraine says a nuclear plant in the east came under attack and is now occupied by Russian forces. The incident is raising the stakes in President Vladimir Putin's invasion as his troops pound cities across Ukraine. Stocks fall and futures signal more losses for Wall Street as the historic week in commodities sends shockwaves around the world. And later today, the U.S. jobs report will be front and center. Bloomberg Economics expects a solid pace of hiring, confirming Fed Chair Jerome Powell's assessment that the labor market has plenty of room to withstand rate hikes. I'm Anna Edwards with Danny Berger in London and Kaylee Lyons over in New York. Kaylee, the European equity markets are really preoccupied, of course, by everything that's been happening on the ground with that attack on a nuclear power plant. Some shelling by Russians of that nuclear power plant, and now the subsequent occupation of that power plant, a fire that there was on the ground there now seems to have been extinguished. But that's made European equity markets really nervous, really jittery, focused on the risks. Whereas US futures, yes, they're down, but not as substantially.
Not as substantially. That's exactly right, Anna. Of course, here in the US, we are also awaiting the February non-farm payrolls report in about 3 hours' time. But as our Mike McKee told us earlier, NFP today doesn't really stand for non-farm payrolls. It's instead not focused on payrolls because the geopolitical situation is really front and center. Now, futures at the moment are only down about 0.5%, so nowhere near the losses we are seeing in Europe at the moment, but it has been a very whippy session as it seems that really with thin liquidity, each and every headline and the resulting move in the market is exacerbated. As for what's going on across other asset classes, the 10-year yield had broken below 170 earlier on in the session overnight. Now we're down about 5 basis points. 179 is where we trade. When it comes to the dollar, you are seeing that haven bid showing up there. The Bloomberg Dollar Spot Index is at its strongest, going all the way back to July of 2020. And then, of course, we've talked about the dramatic price action in the commodities complex. A lot of that has been in oil and natural gas, but it also has been in agricultural commodities, given that Russia and Ukraine really is a huge bread basket. Wheat futures are up another 6.6% today. $12.09 a bushel is where we trade. Wheat heading for the biggest weekly move, 40% on record, as those prices are at the highest since 2008. Now, as for some stocks moving in pre-market trading, you're seeing a lot of the travel complex under some pressure today. Cruise lines like Carnival and Royal Caribbean each down in the range of 3 to 4%. And big tech also is dragging broadly on sentiment. Tesla's down 0.8%. Apple by about 0.7 in early hours, Anna.
So that's some of the pre-market movers, Kaylee. Let's get to the European picture then. And as we were just discussing, the moves here in Europe do seem to be more substantial than we're seeing in US futures. So European stocks down by 2.5% in this morning's session. Some of the big markets in Europe down by more than 3%, in fact, during today's session. The euro, 110, down by 0.5% against the US dollar. And a lot of people talking about just how low this goes from here. I talked to a couple of guests who were talking about 107, maybe 108. Not talking about parity, but we do have some interesting stories around about whether parity will be more coming into view as we go through the months ahead, given the European economy's exposure to what is going on in Ukraine and exposure to geopolitical tensions and to those economies themselves. This is the Brent crude price up by 1.6%, which by this week's standards, not such a substantial move. 112 is where we trade. This is the natural gas price, though, and this is where a lot of the politics gets really complicated between Europe and Russia, of course, because that gas is still flowing through that gas pipeline at much elevated levels. Kaylee.
All right, the complicated politics of war, Anna. So let's have more on that war and the ongoing crisis in Ukraine and start with our top story, which is that Russian forces have occupied the site of Europe's largest nuclear power plant after an attack that ignited a fire at the complex. We now understand that that fire is under control. This raises the stakes in Vladimir Putin's invasion as his forces bombarded cities across the country. We heard from Ukrainian President Vladimir Zelensky earlier.
Europe must wake up now. The largest nuclear power plant in Europe is currently burning. If there's an explosion, that's the end for everyone, the end for Europe.
That was Ukrainian President Vladimir Zelensky talking about how Europe needs to wake up. Let's get more on Europe's reaction to this. Bloomberg's Maria Tadeo, our European correspondent, joining us now from Brussels. Maria, what are we hearing?
Well, Kaylee, we know that there is a NATO meeting that is underway, and of course, the big question today is what should we do with that fire, and how should we interpret the actions undertaken by Russia in what is a very dangerous move? I mean, this is a nuclear plant, and what NATO ministers said today is that at this point, Vladimir Putin is playing with fire. This is reckless, and everyone needs to take a step back. Now, in terms of where we go from here, well, we know there's an active discussion going on behind the scenes that could potentially culminate today when foreign ministers meet after they meet with NATO. There's a debate around what to do with sanctions. A lot of the Eastern European countries say that the current sanctions, they may be powerful, and we haven't seen the full extent because the Russian markets are still shut, but more is needed. And of course, the conversation is moving towards energy. I see many officials behind the scenes who tell me we need to really talk about a full ban of Gazprom, of also oil and gas imports from Russia. And if that means we need to burn coal at this point, we should be doing it. However, Kaylee, remember, this is a decision that will have to be made unanimously by the 27 countries. And just very quickly, earlier we spoke exclusively with the Lithuanian president, who told us this situation is now not just about Ukraine, it's about the precedent that it could set to Eastern European countries and Baltics. And you can really sense that over the past 48 hours, because of the actions taken by Russia, but also the language coming out of the Kremlin and Vladimir Putin, they are increasingly concerned about spillover effects from this Ukrainian very tragic situation, of course.
Maria, more on that commodity market story, if we could. We see gas prices going higher again today, and of course the political conversation continues to focus on the extent to which Europe could do without Russian imports of gas. But the gas keeps on flowing. We keep seeing those daily headlines from Gazprom talking about how gas is flowing normally through the pipeline. I mean, the extent to which different European countries rely on this Russian gas is complicated and very divergent, and that could influence conversations on that front from here.
Yeah, very much. And Anna, as you know very well, the European market is different by nation. They all have different combinations of energy, and they use different methods to, of course, heat up homes and have electricity running in their countries. So this is not a market that is compact in that sense. There's many different national variations. And yesterday we heard from the Germans who said we have to be real about the economic impact and the realpolitik of this. You can't just overnight switch up a whole system. We still need this gas. But of course, the the flip side to this is countries like Poland that are so closely connected to Belarus, but also Ukraine, they feel the real concern from Russian aggression. And the Polish Prime Minister yesterday said, for me, the fact that we still work with Gazprom and Sberbank is completely unacceptable, and there needs to be a conversation as to at what point do we talk about blood money related to Russian energy. So, of course, this is still a very emotional issue, but you have the real practicalities of an economy that cannot switch overnight from one type of energy to another, and that is still incredibly reliant on years of course, Russian supply.
Yeah, I spoke to one commodities expert earlier who was saying it's things that are shipped around that have been subject to more self-sanction than the stuff that is piped. So far, not much disruption on that front. Maria, thank you very much. Bloomberg's Maria Tadeo with the latest on the European view, if you like, the geopolitics, how it evolves. Let us tell you, still to come on the program, Steve Blitz, T.S. Lombard, chief U.S. economist, will be joining us shortly. This is Bloomberg.
Has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines with Anna Edwards and Danny Berger in London. Well, it's jobs day here in America, and more favorable data are expected after weekly jobless claims fell more than expected. A strong report could underpin Fed notions that the labor market is solid enough to withstand policy tightening. Joining us now is Steve Blitz, T.S. Lombard, chief U.S. economist. He is here with me in the New York studio. So, Steve, we already heard from Jerome Powell twice this week, essentially saying that a March hike is a done deal. Does this data today even matter?
No, it really doesn't. I think if it matters at all, it matters in terms of April or May, with the meeting afterwards. I mean, I felt like they were ready to go 50, and they had all the reason to go 50 in March, but obviously the war, equity market performance, they had to ratchet that back to 25.
So do you think that a 50 basis point move could be coming later, especially because this war you speak of in theory will lead to higher energy prices and amplify inflation?
Yeah, look, those types of higher energy prices were more likely to slow the economy, even if they give a boost to the inflation numbers. But there's big concern here is that the economy can be going from this COVID boom to a long cycle. Right, and we're going from an asset inflation, and we could be starting an inflation process. In an inflation process, you have to, as the Fed, you have to get interest rates synced up sooner rather than later, and now is the time to do it.
Steve, good morning. It's Anna here in London. Now's the time to do it. Inflation process, that sounds like a very long-term challenge. How long then before the US really gets a handle on inflation?
Well, there's two inflations here, right? So we know that the inflation from the COVID reopening is gonna fade here in the coming months. The real question is, where does the economy settle? And I've been saying for a long time it's going to settle at 2.5%, 3%. It's not going back down to the 2%. But the longer the Fed waits in terms of getting at least a 2.5% funds rate, it runs the risk of that 2.5%, 3% inflation rate not coming to bear and ending up with something higher. So it's really not about current inflation so much about where the economy ends up 6 to 9 months from now.
Do you find history at all instructive here, Steve? Do you dig out the history books to check out what happened in 1962 over the Cuban Missile Crisis, or go back to the 70s and look at higher oil prices? Do you find that's instructive in working out anything about the future direction for the U.S. economy, for that inflation narrative?
You know, I wish it would, and we always want to sort of hang on to something like that. But this is just an unprecedented situation. I think the Russian invasion of Ukraine, though, and the prospect of more deglobalization and that type of global disruption does have a possibility to leave us with a higher inflation environment, because the low inflation we've had in the United States for the last 25 years is because we've had flat to falling goods prices because of trade and opening up trade and having a relatively strong dollar. That's probably not going to be the case going forward.
Steve, I really like this idea of whether history is instructive. And one of the things that I know I've heard that has been raised as an alarm are what commodity prices are doing. I mean, we've been talking about it here that, you know, not every recession has been led by a 50% rise in crude, as Jim Bianco points out, but every 50% rise in crude has led to a recession. At the same time, the yield curve is just at a minimal 26 basis points. Do these kind of signals worry you right now, Steve?
Oh, absolutely. They absolutely worry me. You know, I wasn't worried before Ukraine. Now it does worry me a little bit, simply because of the sharp increase in oil prices, as you say. But you know, this is part of what makes the Fed's job very difficult, and why they're doing 25, and why they're tiptoeing through this thing, because they really. 50 would make sense. Look, it makes sense just to go to 2.5% on the funds rate right now. We know they're not going to do that, but it makes just as much sense to do that. Why wait? But all these things do matter. But I don't think the economy is going into recession. I think the markets are a little bit more worried than they need to be. And I think that the economy is doing quite well, and we'll see that this morning. Even if we get a 200,000 job number, those were great enough job numbers pre-COVID when you're sitting at 4% unemployment.
Well, this brings me back to one of your notes from earlier this week, and you were writing about sanctions and their impact on monetary policy, writing that how much of a difference it makes for monetary policy lies, as always, with the equity market. What do you mean by that, Steve?
Well, we're in an asset cycle. We're not in a credit cycle. And the historic times you've talked about before, that's exactly what we were in. We're in a credit cycle. And the linchpin for the U.S. economy really for a long time, but certainly over the last decade, has been the equity market. And the way the Fed conducts monetary policy, it is two avenues in which it impacts growth. One is through the dollar, and the other is through the equity market. And if you have a sharp decline in the equity market, it's going to impact spending, and it is going to slow growth. And that is the governor. You know, I was joking before about the Fed going to 2.5%. That's the governor that keeps the Fed from acting as aggressively as it otherwise might want to.
Well, Steve, all we've done really is talk about aggressive Fed action. They haven't actually moved yet, and yet we've already seen financial conditions tightening. How much work has the market already done for the Fed?
Well, it's done a lot of the work, and they're very aware of that, and then part of their communication. I mean, the 2.5% by the middle of next year is there, but if they would front load that and move more rapidly to 2.5%, that does raise the short end faster. It's just the math in terms of the 2-year yield, right? So if they jumped 100 basis points, let's say, if they jumped to 2.5%, let's say in the middle of March, the 2-year probably goes up 100 basis points in yield immediately, right? Now, it maybe even doesn't do all that because then the market will start pricing in an ease. But in terms of just the straight mathematics of it, it would jump. And that's how being more aggressive early changes the dynamics of the market pricing.
Steve, would you expect the jobs report to cut through in the market psychology today, given all that we're seeing in Ukraine? Certainly here in Europe, it's the dominant theme. Looking at the way U.S. equity markets are set up, it might not be quite that way. It might not seem that way from New York.
Yeah, I don't think. Look, this number has to be a big outlier to the downside to really make much of a difference. And even if it's a negative, people will say, well, they'll look at the revisions to January. They'll think there's a lot of wacky seasonals going on. There usually is. So I'm not so sure that you've got. I think I'm very hard pressed to come. I'm sure there is a number that's bad that would have the market really jumping. But I don't think this number is really going to move the needle all that much.
Steve, thanks so much. Thanks for your time and so early. Steve Blitz, TS Lombard, Chief U.S. Economist. We really appreciate you traveling into the studio this morning. Coming up on this program, we will, well, a little bit later, I should say, in programming, we'll continue to focus on that jobs report. We'll speak with the U.S. Labor Secretary, Marty Walsh. That is at 9:30 a.m. in New York, 2:30 p.m. in London. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Anna Edwards and Danny Berger in London. And also joining us now, Tom Keene, co-anchor of Bloomberg Surveillance, who will be breaking down the non-farm payrolls report at 8:30 a.m. Eastern Time. But Tom, is this one of the most inconsequential jobs days in recent memory due to the geopolitical situation?
It's an odd jobs day. I don't know if it's inconsequential. I think there'll be a lot of particularly inflation information in there as we game out inflation next week onto the Fed meeting. But certainly front and center is the war and the adjustment we're seeing right now, Kaylee, in the markets. And I really want to emphasize food has a lot to do with this. Oil's always front and center for the Bloomberg world. Javier Blas makes us do that. But guess what? Wheat matters, and wheat's an extraordinary chart. Here's 6 decades of wheat back to the explosion of Beirut, and then the explosion up here in 98, and the recent move upward as well. It really puts it into scale. And the heart of the matter here, Kaylee, is the great food deflation we saw for a good 30 years.
Yeah, really fascinating, Tom. And we've been talking to analysts, Bloomberg analysts this morning, who've been pointing out, you know, there's obviously the self-sanction goes on here as in other commodities, but there's also just the physical difficulty of planting anything in Ukraine, of getting anything to the Black Sea, all of that very much in the mix. But I know overnight you'll have woken up to the news flow, as many of us here in Europe did, about this attack, the Russian shelling of a nuclear power plant. Important that everyone keeps level heads on this story. And with that in mind, I just saw one headline saying that there are very normal radiation levels coming from here, but the sell-off we see in Europe just shows how jittery we are around these headlines.
Well, it is a war within the new media, and it was such a shock last night. Again, this is the speed of the media that everybody's getting used to. Anna, there you were with a video and literally bullets flying and all. That wasn't in previous wars. This is something new we're dealing with.
Well, Tom, to that point, with the fast nature of this and tail risks quickly becoming the base case, does forecasting the economy, the market, does it have any use in this type of environment?
A really important question, and the key thing there is flows. What I think I see on the screen right now, Danny, is we're having a balance sheet adjustment. We're doing that with the Russian markets closed, so we're not getting a true adjustment, but we're certainly seeing little quivers and movements here. I would really highlight euro testing a 109 handle as we speak.
Yeah, 110.01 at the moment, Tom. We are right on the cusp. What do you make of the dollar strength we are seeing?
Completely normal. It's completely what you'd expect. Also, yen dynamics as well. DXY out over 98 is a big deal. There can be a lot of analysis of intervention. Damian Sassower is truly expert at that, and you know, ECB will be very, very important on it. But it's completely normal to see dollar strength here.
All right, Tom Keene, co-anchor of Bloomberg Surveillance. Looking forward to your coverage of the jobs report later on today. Thank you so much. But while we will be watching jobs, of course, we continue to monitor the geopolitical headlines. The situation when it comes to that nuclear plant that was attacked in Ukraine, we understand that fire is now under control. But Anna, as you say, causing ripple effects and jitters through very illiquid markets.
Yeah, absolutely. Illiquid markets. And we're just seeing some interesting headlines coming through, sticking with the geopolitics around Sweden, around Finland, 2 countries that are not NATO members, about polling that suggests that there's increased appetite to join NATO. So people are jittery, people are nervous, certainly in that part of the world, and that is leading them to look for a different path ahead, look for different alliances. But back to the markets, Danny, certainly you've been focused on a lot of, on that lack of liquidity and those jitters.
Right. Well, look, we don't have Russian stocks trading until at least Tuesday. I am fascinated with this question of what it means if you are a fund in the U.S. and Europe and you hold Russian equities that you're mandated to get rid of, but you literally can't. You literally cannot sell them. We've had past experiences of this, be it Greece during the sovereign debt crisis or Egypt during the Arab Spring, but eventually those markets reopened and things settled. Kaylee, I mean, it's this huge question mark. What happens if the Russian market never again opens to foreigners?
Yeah, I don't know if any of us know that answer to that question. But of course, while you can't really sell Russian assets, also people are acting as if they can't buy them either, even when sanctions aren't actually formally in place when it comes to things like Russian oil and gas, Anna.
Yeah, absolutely. The self-sanction we talk about quite a lot and certainly extends to many different asset classes. That is it for this hour of programming. More Bloomberg Surveillance, though, is ahead. They'll be having a conversation with Randy Krosner, University of Chicago Booth School professor of economics and, of course, former Fed governor. Interesting to get his perspective on the jobs report, how that cuts through right now. And, of course, team coverage of the situation on the ground in Ukraine, the Russian advance there and the humanitarian crisis. This is Bloomberg.
this chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
Capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
This is, in many ways, the second Cold War.
We are coming out of a pandemic, and now we are going into another shock.
Worst case scenario, oil continues to rise and we hit 150. You're going to get an inverted curve.
The Fed is in a very tough place here.
Go too fast, they risk stagflation. Go too slow, and 7.5 and rising inflation can become entrenched.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Futures down 8 or 9/10% on the S&P. TK, stunning pictures overnight.
About 7:30 last night, we all saw it as war in real time, John. I mean, I'm sorry, the digital revolution, the social media and all makes it so damn immediate. We saw that last night, the good news of a fire out. But what I see this morning, John, is a real weekend balance sheet adjustment, even with the Russian markets closed, and you see it with euro on the cusp of a 109 handle.
Away from the market just for a moment, if you're just waking up this morning, let's go through this piece by piece. So overnight, a nuclear plant in the southern part of Ukraine came under attack by Russian forces. A fire broke out at a training complex at that plant. We understand that fire has now been contained. Some of the headlines that we understand this morning from the IAEA, they informed us this morning, no change in radiation levels. That is really important, Tom. Also, we learned that it has not affected essential equipment. We do know, however, Tom, that Russian forces are now in control of that site. Any additional headlines, of course, Tom, we'll keep bringing them to the audience through the morning.
This is coming north out of Crimea, which has been the real thrust here of the Russians. And to me, John, a real headline here, as we're all on a learning curve, is that this is a nuclear-powered country. There's a lot more other reactors to come if the Russians continue to advance.
To get in response worldwide to this, Lisa, this from the NATO Secretary General Jens Stoltenberg, it just demonstrates the recklessness of this war and the importance of ending it.
That's, I think, the sentiment pretty widely held throughout the world, especially because this power helps to generate a lot of the crops to grow, a lot of the necessary commodities that come out of this nation, in addition to the 44 million people who live here. But we are finding out, even if there has been some sort of disaster averted, as was warned by some of the Ukrainian officials, what does this mean going forward in terms of ramping up the conflict and taking steps that really haven't been taken before? And we're seeing that from Vladimir Putin.
Lisa, today there is a NATO ministerial meeting. Yeah. Secretary Blinken will be attending that. This is clearly for many people an escalation overnight coming into this morning. How are we expecting them to respond to it?
Honestly, that's a really great question, because how far can they go without hurting themselves, or at least incurring more of the pain, which they've been reluctant to do? We've certainly heard that from President Biden. However, members of Congress have a very different message. You can see the splintering right now of people who want to go as hard as possible on sanctions, and others who won't even want to take additional steps.
So live pictures streaming in last night as that started to happen. Equity futures rolled over. Let's whip through it for you. We snapped back a little bit, but futures are still negative on the S&P. We're down by 0.8%. On the week coming into Friday, the S&P 500 only down 0.5%. Tom, in Germany, the DAX is down almost 9%.
Yeah.
And go through some of the banking names. They've lost a quarter of their value this week in 1 week alone.
That's so important, John. The idea here of, yes, there was a snapback of U.S. real 10-year, came back nicely off near a negative 1.00, but that doesn't tell the story of the balance sheet adjustment I see underway again into the weekend. You see it across every nation and front and center in Europe.
Lisa, go bank to bank. Raiffeisen down about 26% this week. SocGen down 24. Deutsche Bank down 21.
Yeah.
It has been brutal for these names.
How do you measure not only the potential fallout from the Russia sanctions, but also from commodity prices increasing to such a degree and slowing growth? How do you factor in some sort of stagflationary environment to banking statistics right now, let alone anything else? One thing we have not mentioned so far is that today is the payrolls Friday, and yet that seems to be completely lost in the conversation, because does it even matter at a time when there seems to be a greater existential threat? Yet at 8:30 a.m. we do get that U.S. February jobs report. It is expected to come in as a deceleration at 423,000 versus the 467,000 of January. I'm watching, frankly, the average hourly earnings, which are expected to increase yet again to a new high on an average basis going back a decade, not including some of the disruptions during the pandemic era. But again, how much does this matter as you try to offset some of the increases that you're seeing in gas prices, in aluminum prices, in wheat prices, and all the other commodities that have been affected? At 1:15 p.m., Secretary of State Antony Blinken is going to be joining that NATO meeting that you were talking about, John. He's going to be speaking to press in Brussels, talking about some new sanctions. Yesterday, he said these individuals, the ones that were sanctions, the oligarchs, part of President Putin's inner circle, have enriched themselves at the expense of the Russian people, and their support has facilitated Putin's war of choice against Ukraine. Okay, that's nice. Now, what about those oil sanctions? That's what everyone's going to be talking about today, in addition to additional steps. And Saturday, China very much in focus, and China matters for the Ukrainian situation as well. They're beginning the National People's Congress with a speech outlining economic goals. They're expected to ratchet back their estimated GDP to between 5% and 5.5%, which is the slowest since 1991. But John, honestly, I'm curious to hear what they're going to say about Ukraine. How much are they going to start to step more into this conflict, since they have been amazingly quiet with respect to their previous alliance with Russia?
Lisa, thank you. Team coverage starts right now. Bloomberg's Aggie Cantrell in Poland, Maria Tadeo in Brussels, Belgium, and Emily Wilkins here in the US down in DC. Aggie, just to begin with you, stunning footage overnight. We were all gripped by that. What have we learned so far this morning?
Hi, John. So it's important to state that this nuclear reactor, this nuclear plant, when it went on fire last night, it was a training facility, as you mentioned at the top of the show, that had caught on fire, and now it is under Russian occupation. However, the material in the nuclear plant is deemed to have not been affected. What is important to note, however, is that this is also showing the progression of Russian troops from the major urban center that they managed to capture in Kherson, and this is going up the Dnipro River, 230 kilometers up to where this plant is located.
Aggie, good morning from New York. I'm curious, into the weekend, the belief that the Russians will turn west at some point.
I think it's difficult to say right now. It's clear that they have been pushing a lot into the south of the country, and there have been talks about where they would go next. But I think that this is also important to see that President Zelensky of Ukraine said that he saw that what has happened overnight with this attack on this plant, it should be a wake-up call to Europe, that this is something that if anything were to go wrong in any one of these conflicts on the ground, this could be a serious concern for the entire continent of Europe.
Maria Tadeo, we have NATO ministers meeting today in Brussels, talking, I'm sure, about what the next steps are, as this is deemed very much an escalation. What's on the table?
Well, Lisa, of course, everyone here was concerned after the footage, and the message that I've gotten from officials that are already at NATO headquarters in Brussels is that A, they were shocked, shivers when they saw the footage, but two, a very clear message that Vladimir Putin is now playing with fire, but two, we have to be very careful about not escalating on that front. I had an official that told me, if you look at everything that's happened over the past 48 hours, he's escalated militarily. We've seen what happens with the Russian bombings from the air to the ground, but then two, you see that Russia keeps bringing up the nuclear aspect to this. Vladimir Putin said, I will put my nuclear forces on high alert. Sergei Lavrov repeated that yesterday. And of course, we had this attack that has now been confirmed was shelled by Russians in a nuclear plant. The Europeans say this is now concerning on that front because there is no hint in any way that Russia plans to de-escalate. And I would also point to a speech yesterday by Vladimir Putin on Russian TV in which he said the operation will continue and our goal is to denazify the country. He repeated 10 times, we have to get rid of the Nazis that govern Ukraine.
Maria, Mr. Putin out with headlines right now. The headline, folks, is simple. Putin says he has no evil intent toward neighbors. We do understand, Maria, that the neighbors don't include Ukraine. Andrea Kostikov of Carnegie Endowment for International Peace writes in Foreign Affairs this morning of the news blackout to the Russian people. Maria, what is Brussels and others doing about informing the Russian people?
At this point, the reality, and it's a sad reality, it's almost impossible to get independent journalism going on in Russia. In fact, we know that Russia is going to clamp down on anything that they fear is a threat to the Russian military and the Russian operation. So that means shutting further news outlets and, of course, even potentially fining or sending to prison for up to 15 years anyone that spreads, quote, fake news about the military operation that's ongoing. And it's very telling, Tom, that in the Russian state media, nobody talks about a war. They say this is a military operation and this is a peacekeeping operation to protect the people of Ukraine. By the way, yesterday, Vladimir Putin repeated, I will never give up my conviction that Ukrainians and Russians are the same single one people.
Emily Wilkins, down in Washington, D.C., is President Biden controlling the narrative, or has he lost the plot as a growing number of Congress members call for oil sanctions on Russia?
Well, it's definitely a huge split within the Democratic Party to hear House Speaker Nancy Pelosi say yesterday that she was completely in support of banning oil from Russia. You also saw the bipartisan press conference yesterday between Senator Joe Manchin, Senator Lisa Murkowski coming out saying that they would also be supportive of this. I mean, this is a clear break between congressional Democrats as well as the White House, and it puts pressure on the Biden administration to take this proposal more seriously. At this point, the Biden administration says that the reason they haven't done this is because they're worried about the impacts it could have on the global economy, on the U.S. economy, on gas prices. That's something the Biden administration is very cognizant of, that they have to be dealing with the inflation while they are dealing with this Ukraine crisis. And the Biden administration is also under pressure from shale companies, saying that this is another area where the U.S. could be a little bit more reliant on what the U.S. produces, less so on what Russia produces. But at this point, we haven't seen any signs from the Biden administration that that's going to be the route they take.
Elisa, that line from Speaker Pelosi, quote, ban it, ban the oil coming from Russia. Pretty clear about it.
And honestly, then you had Jen Psaki coming out, the spokesperson for President Biden, saying that they really want to be cautious to protect consumers at the pump. So what's the message, right? I mean, how much has there been a cohesive message coming out of the White House?
Emily, down in D.C. Emily, thank you. To Maria Tadeo, to Aggie Cantrell, to all three of you, thank you very much. Some price action I want to pick up on, just briefly, and it takes place in Europe. Euro-dollar with a brief break of 110. It's been a while. 1.09998 right now.
Nice quote.
Breaking down. I think I butchered that. I'll do it again. 1.0995.
Nailed it.
Euro dollar. Thank you, Tom. Lisa, euro dollar breaking down, I believe, for a fifth straight session.
Yeah, it's the weakest since May 2020, and this really highlights the divergent fates of both the U.S. and Europe in the face of these stagflationary shocks. I mean, how much can Europe do something? And there was a story overnight from the European team at Bloomberg talking about how it's almost a given that the ECB will push back any rate hiking cycle in response to what you're seeing right now with commodity prices.
And just to pull through the European lenders, UniCredit, Tom, down by 9.4% this morning. Looking at Deutsche Bank down by 8 percentage points. SocGen down by 8% as well. ING off by 7. pretty brutal out there for the European banks.
This is old world analysis of Nassim Taleb, Noel Rabini, even the great Stephen Roach does this. You go to the balance sheet analysis. We can't do that with Russia now, John, because they have really not adjusted, including ruble. But in other places, those adjustments are happening in real time.
Lisa, these weekly moves are something.
Honestly, if you take a look just even at benchmark European stocks, they are down for the biggest weekly loss going back to 2020 at the height of the pandemic. You could see the move, honestly, on wheat. I am just blown away on this. 40% weekly gain. That is what we're looking at with limit up types of price action every single day as people game out what could potentially happen from the Ukrainian disruptions. This is just unprecedented.
Some big moves in the market and some big developments overnight. Overnight, you will have seen the pictures of a nuclear plant coming under attack by Russian forces. We understand the fire has been contained. The fire broke out at a training complex. The IAEA informed us this morning no change in radiation levels, and the essential equipment was not affected. That's the good news. Russian forces now in control of the site, and we'll be exploring the headlines for you throughout the whole of this morning on radio, on TV. This is Bloomberg.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
What do you think is the impact of the Prime Minister on the market?
As Mr. Suzuki, who is the Financial Services Minister, he mentioned at his own press conference, and share buybacks is widely used to return profits to shareholders and improve ROE. And how to share out the profits from growth is, totally the decision of the management of each company after carefully taking, all the stakeholders into consideration. And I believe Mr. Kishida has a quite cautious stance on the uniform regulation of share buybacks. And I think because he is giving a consideration to each company's, individual circumstance and, decisions.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Physical integrity of the plant has been compromised with what happened last night. For us, the IEA, it is time for action. We need to do something about this.
That was the IAEA Director General. Didn't give you the whole context, so allow me to get you up to speed as he talked about what happened with the site. We understand this morning the fire has been contained. Tom, this morning, no change in the radiation levels. I want to repeat that. We learned this morning as well that it has not affected the essential equipment. They were the main takeaways from the IAEA this morning.
My main takeaway, John, was that the Russians were shooting at the firefighters, and there's a bunch of other reactors to come here across even to northwestern Ukraine, up by Belarus and Poland. I think it was a real lesson, perhaps, of what's to come in the coming days.
Futures down 0.9% on the S&P. That's the story in the US. Over in Germany and Frankfurt, the DAX down by even more. Wow. I mean, the euro breaking down through 110, 10988. But the moves we're seeing in the European banks, Tom, are something.
Well, they are. The banks are there. And again, I'm going to call it one big balance sheet adjustment. We'll dive into this data on this jobs day as we can. Joining us now with a terrific brief, Alan Ruskin, Chief International Strategist at Deutsche Bank, and they're a research combine of David Folkert's Landau that is writing piercing notes right now. Alan, I loved your adult note on geopolitical proximity. What are the proximities that Christine Lagarde faces in the coming days?
Well, I think, when you certainly look at it in the context of currencies, and I think currencies are probably a useful way of viewing the world. There are a few things that most influence currencies at this point. One is obviously geography and geopolitics. There's a humanitarian aspect to this, of course, that we should put top of the list. Related, there's also a policy response, which means effectively easier monetary policy the closer you get to the conflict, and probably more fiscal stimulus, so change in the policy mix. And then, of course, you've got a terms of trade effect. So in Europe in particular, there's energy dependence that we're all watching very, very closely. And that compares, of course, to some countries like the United States, like Canada, where there's much reduced energy dependence on Russia.
What have you learned about what you call the inflation overshoot? You hearken back to Milton Friedman. You go all monetarist on us, Alan. I can't believe I saw that. But the fact is, M2, I guess, matters. We had a pandemic, and now we're clearly having some form of anti-transitory move. Is there more to come, and can you and Deutsche Bank model out wheat, model out oil, etc.?
Look, I think there are a few different factors behind this inflation story. The most obvious one was the supply chain bottleneck story. That was, a story that permeated and came forth in March of last year. Behind that, I think, was the idea that there was a huge monetary overshoot that was essentially allowing prices to go up across a wide swath of the economy. And that we've actually seen now. In addition now, you have the commodity price implications. So that's effectively another supply shock, a different supply shock. The first one was manufacturing chain related. This one's commodity related. But I think the problem, of course, you have is that if you thought things were transitory in the first instance, obviously that hasn't come to pass. You've hoped, I think, that inflation would be under control by the end of this year. You've got a commodity, and that's dampened those sorts of expectations as well, and meant that inflation's much more entrenched in the system.
How much further does this euro weakness have to go, Alan?
Yeah, good question. I mean, obviously, things are changing pretty rapidly as we talk. We've broken some pretty key levels. DXY yesterday, I thought the 97.80 level was important, targeting 100 on DXY. On Eurodollar, the most natural levels are sort of a 107.80 or thereabouts is I think the next target. were it to break to lows that we haven't seen, since, before 2020, before the COVID era, that would be below 106. I don't think that's going to happen too easily. I think the euro's traded quite impressively, in part because people anticipate a large fiscal stimulus, in part because I think you are still getting safety flows from countries like the CE3.
Do you buy the idea that David Folkerts-Landau put out there that the ECB should intervene here by saying that they still are considering raising rates this year to support the euro?
Yeah, I mean, it's an interesting one in terms of, just trying to get the policy mix right. I think, the interesting angle there was, whether they could still raise rates, get rates above zero, which I think is ultimately going to be a helpful phenomena from an economy standpoint, but at the same time suppress the negative growth implications by doing more QE and effectively keeping long-term rates lower, and that thereby sort of helping the periphery in particular. So it's really, I think, a story of trying to get the right balance between short-term rates and long-term rates.
Alan, I just wonder, just to wrap things up, before the Fed starts hiking, once they do start hiking, we'll have rising interest rates at the Fed. We'll have a stronger dollar and a rallying commodity market. Do you think those three things can coexist?
I think they can for a while. Unfortunately, I mean, you feel like the policy response to higher inflation that we were talking about earlier ultimately brings about a sharper slowdown and ultimately brings about a sort of stagflationary environment. I think it's still too early to talk about, very, very soft growth. But I think that's the way that the main transmission from commodity prices onto slower growth and stagflation is usually by policy tightening. And the Fed's just going to have to deal with, what is an increasingly problematic environment here. I mean, you're dealing with growth slowing and inflation going up. I mean, and even if inflation starts slowing, it's going to slow by less than expected. So all the second derivatives are not really working in terms of making policy easy at this point.
It's tough, really difficult. Anna, thank you. As always, Alan Ruskin there of Deutsche Bank. Morgan Stanley came out with their call for payrolls. We've hardly talked about payrolls, have we? The estimate 423. Their estimate 730 in February, 730,000 leads. So they expect average hourly earnings to rise 0.4% on the month, lifting the year-over-year rate to 5.7. And of course, 5.7 just does not get you to where inflation is right now.
And basically what we're looking at is a labor market that has more signs of looking very overheated in some capacities. Honestly, to that point, the sort of bigger than expected expectation from Morgan Stanley, did you hear what Jerome Powell said about how there are signs of an overheating labor market with the JOLTS data, with the job openings, basically talking about how this does seem to be something and signaling something of at least wage momentum that's getting their attention.
I didn't hear a dovish chair this week, that's for sure.
Me too.
I can tell you Secretary Blinken's going to be a busy man today. So he's going to be meeting with NATO Secretary General Jens Stoltenberg. That'll happen a little bit later. Then there will be a NATO ministerial meeting as well, a G7 ministerial meeting taking place as well, Tom, in Brussels, Belgium.
It's a 5-6 day trip for Secretary Blinken. He's doing a Kissinger act, going from country to country here around Eastern Europe amid this crisis. John, Euro Swissy, when does Swiss Bank intervene?
Euro dollar, a break of 110, 109, futures down by 0.8% from New York City. It is payrolls Friday. It just doesn't feel like it. This is Bloomberg.
this going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And, if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project, initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the angstrom era when we're going to 2 nanometers and below into the angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
We're in London, in Sydney,
in San Francisco,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
how
story.
are you thinking about those dynamics?
Coming into Friday on the S&P 500, we were down about 0.5%. The DAX down much more. On the week so far, the DAX down by 9 percentage points. Brutal out there. Futures down by 0.8%. There's a big difference, though, between what's happening in Europe and what's happening stateside. The losses here are much, much smaller. Futures on the NASDAQ, we're down 0.7%. Into the bond market, 2s, 10s and 30s. Treasuries look a little bit like bunds. If you look at the price action, yields come in. Yields down 6 basis points. The curve a bit flatter. We're down 3 on 2s. Just a break at 150 at 149. It will be very interesting to see how we react to payrolls. The estimate in and around 420. Chairman Powell didn't sound dovish this week when it comes to the U.S. economy. The U.S. economy and the data we might get, it's going to look good, Lisa. And if it looks good, how do they respond to it a week away from CPI in America, which could have an 8 handle?
Does it even matter right now? I mean, honestly, it's amazing when you take a look at all of the commentary that's coming out this morning. No one's even mentioning the jobs number. How much can they move when there's another stagflationary shock affecting markets that people are really focused on?
Just not part of the story right now,
no.
Is it? In any way, shape or form. Switch up the board and finish on this on crude, WTI and Brent. Stunning pictures overnight. Tom, the good news, the fire at that nuclear plant contained. The good news, we understand radiation levels haven't changed. Some good news out there off the back of something that for many people, Tom, last night was quite scary.
It was really, really scary. I mean, there was a point there, John, on New York Times, 7:30 to, I'll say, 10, 11 p.m., where there was truly a legitimate panic out there, and that panic has calmed down. John, I would really emphasize this morning that some of the spread statistics we look at in the United States are really ugly. They're not European ugly, but they are a different framework than 2-3 days ago.
And this happening with crude climbing, Tom.
Yeah.
WTI just short of 110. Brent's at 112.50.
We're going to do a different jobs report right now with Carl Riccadonna, Chief Industry Economist for Bloomberg Intelligence. And Carl, I'm going to rip up the script here this morning. I did a standard deviation study on the vanilla spread, the difference in the 2-year and the 10-year. And we've really broken down into a recession kind of indicator, one standard deviation below the norm going back a solid 35 years. All of a sudden, Carl, we're on the edge of there. How close are we on a GDP basis to recession?
Tom, I think we're a long way off from recession type of considerations for GDP, and we can see that in the relative resilience of equity markets. For example, they're down year to date, of course, but they're surprisingly resilient given the geopolitical events we see taking place halfway across the globe. That being said, the flattening of the yield curve is an important signal of the direction of growth, the second derivative on growth, and we can see a flatter yield curve implies a significant growth slowdown. And in fact, that is already baked into the forecasts of both economists and also the Federal Reserve, where this year we will see nominal GDP decelerate from about 12% at the end of last year to something in the vicinity of 6% at the end of this year. That's a very sharp growth slowdown. Part of that's moderating inflation, but that is being expressed in yield curve fundamentals.
That's a Chinese economy you just described. We're not China. What is normal nominal? What are we heading towards?
Well, we're not China, but we were a little bit Chinese last year because we had tremendous state intervention into the economy, trillions of dollars supporting economic growth, which are no longer there this year. So we're becoming un-Chinese in 2022. A more steady state long-term level for the U.S. economy would be something closer to about 4% nominal GDP, which would reflect 2% inflation-adjusted growth and 2% headline inflation. We'll be close to that in 2023 and probably arrive there in 2024. That will be kind of the Fed's longer term objective. And if we're moving in that direction, then the Fed officials can take confidence that they're doing the right thing. They don't need to act more aggressively or change the pace. And just to step back to Lisa's point about the relevancy of payrolls to the Fed outlook, it's not impacting what happens on March 16th, but this does shape how the Fed is looking at action further out this year, maybe taking 50 bip rate hikes off the table at later meetings. More importantly, we have a financial instability concern very prevalent in the markets in Europe and the US, and we have a Fed tool that potentially causes financial market instability as they unwind the balance sheet, and we don't fully understand the consequences of that unwind. So it may marginally impact the profile for the Fed funds rate. I think more materially, this may be pushing back the start and the pace of the balance sheet unwind, maybe even until after the Jackson Hole conference at the end of the summer.
Carl, monetary policy nuance doesn't read that well on a morning like this when people are trying to game out what's the meaning of $150 barrels of oil when you take a look at a U.S. economy. What's the resiliency to some sort of broader military conflict? I mean, there are all sorts of scenarios that people are trying to game out. When just taking at commodity prices, what oil price could make you rethink that statement that we're not that close to a recession?
Well, $150